Speaker of the House.
And sometimes supply doesn't matter. Typically in economic downturns, people will be willing to finance the deficit, buy Treasury bonds with exceptionally low yields. Ed, is this a situation that can be addressed with bad economic data? And what I mean by that is, will we buy this bond market? Will those auctions look better if this economy looks worse?
Well, for all the volatility we've had since the summer, I think we're clearly looking for a yield level at which the market will clear. And I think 4.5% to 5% should do it. So I think some of this recent volatility, as long as it's range bound, is actually a good sign that the bond market figures this is a good yield relative to the inflation outlook. I know there are a lot of people that were concerned about the inflation numbers, the CPI numbers that came out yesterday. But if you take out shelter, I always take out things that don't support my story. If you take out shelter, the CPI headline core were both at 2%, exactly at 2%. It's that shelter that's just way too blank too high. That's been the problem. And even in the latest number, it was a problem. But we know that lease inflation on new leases has actually come down substantially.
And I love that you said that. You take out things that don't support your story because it's what everybody is doing, and you can take out whatever data that you want and support whatever story you want to write.
Correct.
A lot of people are looking at the volatility of the bond market, and you heard Michael Shaul yesterday talking about how something will break and that will be something problematic for the markets that the Fed is going to have to respond to. Do you have the same feeling, or is your response the opposite, that the resilience that we have seen in risk assets to date in the light of such volatility is a sign that it can continue regardless of what the bond market does?
Well, I've been in the soft landing camp since early last year, and I characterized it as a rolling recession that's hitting different sectors at different times. And something is breaking right now, and that's in the commercial real estate market. There's going to be a lot of things breaking in the commercial real estate market, and I think it's one of the reasons the Fed is probably done raising interest rates, because they realize that the bond market's been recently doing all the heavy lifting in monetary policy. With the bond yield up close to 5%, that's a disaster for a lot of commercial real estate deals that have to be refinanced, or the value of commercial real estate. So those things are going to break, very reminiscent of what happened in the early 1990s when we had the S&L crisis. A lot of things broke in the commercial real estate market. We did have a recession back then, but it was very mild. It was just the growth rate that was really hampered by all those problems.
Let's tie that together, because we heard from the Wells Fargo CEO saying that they do expect commercial real estate losses to increase. They are expecting loan losses to increase, even though provisions are not necessarily increasing as much as people previously expected. Is your sense right now that we're seeing things just soften and that we're not going to actually see anything break, and that basically it's all been priced in based on where we are in this cycle?
Yeah, well, I'm still in that rolling recession camp, and indeed, in some areas, it's starting to look like a rolling recovery. I think in the retailing sector, for example, consumers may very well be coming back to buying some goods. The single-family housing market looks like it's bottoming. But yeah, I still don't think we're going to have an economy-wide recession going into next year. I think the economy's resilience is going to be proven to be with us. And I think it's largely because of the consumer. And there's a lot of moving parts in the consumer. One of them is you got 75 million baby boomers that increasingly are retiring. And talk about excess savings. I know Jamie Dimon has been saying since May of last year that consumers are going to be running out of excess savings, and that's when we have a recession. But the baby boomers have a lot of excess savings in their retirement assets, something like $75 trillion. And as they retire, they're going to be spending those assets.
Do those boomers not like Dom Perignon, LVMH, Ed Yardeni? Was that not the canary in the coal mine?
Well, look, I think that the retiring consumers are going out to restaurants. They're taking vacations more often. They're flying. They're using hotels, motels. And these are all the areas where industries are very labor intensive. And I think it explains why the labor market's been so tight. It's very hard to have a recession with record employment. I know employment's always at a record right before recessions, but it just keeps going on. It just keeps rising to new record highs. So as long as that's the case, I think that the economy's resilience is going to be attributable to the consumer. And by the way, we know that the fiscal policy is out of control, but part of that is because they're spending a lot, which is stimulative to the economy. Even those net interest payments that they have to make, somebody's getting them. Consumers are getting a windfall relative to what they had, past several years of much higher net interest income.
You sound constructive, Ed. It's good to catch up. Ed Yardeni, if you had any research on LVMH and consumer spending, our producer just wrote in, what's the trade down from Hennessy? You see the spirit spending at LVMH, it was terrible.
Well, I
think they were down 14% in that unit.
Do you like champagne?
Dom, yeah, sure.
Really?
Yeah, who doesn't like champagne?
Sure.
Lisa,
Prosecco is way better.
Ramo, what?
I really don't.
Prosecco is a little bit better because it's drier.
It's drier, and it doesn't give me a bad feeling in my stomach. I can't do champagne.
Okay.
Just letting you know.
Yeah, but Dom Perignon is not necessarily.
In 2013, Dom, we'll hook you up.
Yeah.
All right, thank you.
That's a good one. Anytime. Programming note in the next hour. No drinking. Mohammed El-Arian of Bloomberg Opinion, Queen's College, Cambridge, Julian Emanuel of Evercore, Tiffany Wilding, PIMCO, John Stolfus, Oppenheimer. If that's not enough, Tom Keen's panel coming up a little bit later as well. We'll take some of that in about 30 minutes. TK sitting down with 3, 4, 5 panelists, I think, 2 of which the IMF's Gita Gopinath and also the ECB President Lagarde. That's going to be an interesting one, Bramo.
Especially given the stagflation talk that we've been hearing about and the fact that I saw one note from Deutsche Bank today talking about a double-dip recession in Germany and the potential for real pain there. In some ways, Europe has been in the crosshairs of everything this year, whether it's the war with Ukraine or some of the spill-through from the turmoil in the Middle East. And that's really going to become at the forefront of her call as she talks about the euro and she talks about humdrum rates. She's got a real tough between a rock and a hard place kind of decision to make.
All of that coming up in the next hour. I can squeeze in this as well. Our good friend Shanali Basek taking over the reins of Bloomberg Real Yield. That's going to be very cool.
It's very exciting.
Is it still at 1 p.m. Eastern time?
It's still at 1.
Good to know.
Do you remember when you ran it?
I do remember. How many months ago was that?
I think you started
I think it was at 1 p.m. It started at midday, then it went to 12:30, then I think it went to 1 o'clock, and it got moved around several times. But once we got to about 1 o'clock, I was like, it's getting a little bit late.
Yeah, especially because you'd have to really stick around for the University of Michigan sentiment survey.
I love sticking around for you, Mitch. What time is you, Mitch, out?
10 a.m.
I'll be straight out the door.
Oh, I know, 9:59.
Shanali, good luck. Looking forward to the program.
I
Thanks for
like
your
talking
coverage.
about bonds. I'm happy to stick around on a Friday.
I know you do. You like talking about banks as well. More from Shanali on the latest earnings on Wall Street. A little bit later on Bloomberg TV and radio. Equities unchanged on the S&P 500. Bond yields a little bit lower this morning, down 9 basis points, 460.62 on a 10-year. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. we've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance on a day of bank earnings. John Farrow off to his next property. Tom Keene is in Marrakesh. Luckily, Anne-Marie Herdern has not abandoned me, and she is alongside me, Lisa Abramowitz, as we carry you into 1 hour to the opening bell. We do get, of course, the earnings calls, 8:30 a.m. and about just now. We are expecting to hear from J.P. Morgan on their call. In the meantime, we are looking at basically completely flat S&P futures. Nobody knows where to go with all of the potential tumultuous action. We see the euro basically unchanged, and the dollar as well. This is not a particularly exciting tape, 105.35. 10-year yields lower. This is where the excitement has been and continues to be. Down 9 basis points after yesterday, a massive sell-off in the price increase in yields in the 10-year after a 30-year auction was really, really weak compared to expectations, even though yields were the highest at the sale going back to 2007. And a bid to crude, and we haven't talked about this, but Anne-Marie, seeing crude up more than 4.5% really speaks to the concern right now as we keep hearing all sorts of rumors. And this is a rumor mill, and we are not going to edify rumor, but real questions around at what point we're going to lead to some sort of massive escalation.
Well, CEO Jamie Dimon today talking about the concerns he has around the world, and he particularly talked about the food market, global grain, and energy prices. Because if Iran was to enter into this conflict, you're going to have some serious concerns on the energy front.
We will keep track of that for you as well. At the same time, in a day of a lot of action, we're nearly 1 month into the UAW strike against the 3 auto makers in Detroit. We seem to be at a stalemate of sorts. UAW escalating the strike by walking out of Ford's most lucrative plant, the automaker saying its offer of a 23% raise is the best it can do.
We have reached our limit. We've actually stretched ourselves to get to this point. We're open to moving some money around within the deal that might fit the union's needs better. But broadly speaking, from an overall cost of the deal perspective, yes, we're there.
That was the president of Ford Blue. And joining us now, Bloomberg Detroit Bureau Chief David Welch. And David, this has been the question all morning. What's left? What are you expecting to hear at 10 a.m. from Sean Fain?
Look, he's really been very unpredictable. We didn't expect him to walk out another plant in the middle of the week, and it almost seems like a tantrum walkout almost, where he just got fed up and left the table. And look, he could add more plants here to see if he can possibly get any more out of Ford or out of the other companies. But it really does sound like Ford especially, but the others' offers are not far behind. Everybody's kind of at their limit of how much they can spend on this next 4-year labor contract. And they have a fixed amount of money that they can raise their labor costs for the next 4 years. And they've got to be getting pretty close to it. So we'll see at 10 o'clock this morning if UAW President Sean Fain thinks he can squeeze more out of them, or if maybe he's going to. I don't think we'll see a deal, but he could extend the current strike at the current plants while they just sort of finalize a deal if he thinks they're at the limit. Otherwise, maybe he adds to try to get more.
Ford officials said they were pretty shocked about the Kentucky plant. Did he pull this wild card too soon?
I don't know know if he pulled it too soon. It almost seems like there was a misunderstanding between the two of them, or they were talking past each other maybe, because Ford said they made it clear they couldn't add to the economics of the deal, and he said, Sean Fain that is, said that the union was expecting to add, that Ford would add more to it. They're at a 23% pay raise over 4 years, plus a cost of living allowance, plus some add-ons to the retiree benefits for the workers, not a defined benefit pension, but adding on to those retiree benefits. The open question is, what's Ford going to do for future battery plant workers? Will they automatically be part of the union and pulled into this master agreement? Will they be paid the same? That could be an area of disagreement. But Fain was specific that it was economics. And look, this is a very rich deal as it stands from all three companies right now, and I think it would be ratified pretty easily. So I'm not sure how much farther the companies will go. And Sean Fain will either have to accept it or we're going to have to buckle in for a longer, nastier strike.
David, how can they promise workers jobs at battery plants that they don't even have yet?
It's complicated. There is some precedent for it. Ford had a plant in Michigan years ago that made dashboards, plastic parts, and that sort of thing. And before it opened, Ford agreed that it would be part of the national agreement. But you still do have to organize the workers. Basically, companies can pledge what they call a card check or a neutrality promise, where if half the workers simply check a card saying they're interested in the union, the company will automatically recognize it. And then the company can extend whatever wages and benefits they want to those workers once that's done. It's tougher to do in right-to-work states, particularly in the South, particularly in Tennessee and Kentucky, where Ford has a lot of manufacturing and where they're planning a battery plant. So it'll get very interesting to see how that's going to work out. But I think what the union wants is for the companies to automatically recognize these plants and then give them these master agreement wages once they get there. And I think that's where the fight will be, because EVs don't make a lot of money. A lot of them lose money, and promising top level pay and benefits to make batteries for vehicles that are losing money right now, I think you're going to see a wrestling match over that.
Bloomberg's David Welch, thank you so much, and I'm sure we'll speak with you soon to get the latest. Meanwhile, we have been getting bank earnings throughout the morning. They have been beating across the board, and we have seen record net interest income at JP Morgan, similar types of expectations for that to continue at the likes of Citigroup as well. Joining us now, Lauren Goodwin, economist and portfolio strategist at New York Life Investments. Lauren, what's your take of what the read-through is from the banking earnings we've gotten so far on the rest of earnings, and frankly, on just the role of banks for investors that have been underweight so far this year?
Well, the bank's earnings are telling us, frankly, what we already knew about the economy in the third quarter, which is that we are seeing some early signs of weakness in low-income segments of the economy, but overall, things are okay. We have to keep in mind that bank lending conditions and monetary conditions have been tightening for 18 months already, and so the likelihood that we saw a meaningful surprise here was relatively low. Now, if I expand that to the broader economy and earnings for Q3, I expect we might see more of the same. We know what's been going on in the real economic data, and earnings expectations have already been revised down fairly meaningfully, especially in cyclical sectors. So I think we may be able to see an average rate of beats, and recession just is nowhere to be seen yet.
So are you getting more bullish as you see some of these results?
On the economy, no. And that's because when we see the Fed raise interest rates, the economy tends to evolve in a very similar level. And what I'm seeing in the data and in the markets are signals of late cycle economics. However, until we see signs that recession is already here, the equity market doesn't tend to react to that. And so rising unemployment claims, earnings deterioration, those are the signals that I'd be looking for to get much more bearish in the equity market. They're not here. And so it's an environment where, while we may expect a little bit of sideways activity, lots of volatility, it's one in which it's important to be invested.
So sort of dancing in the twilight, basically trying to get to a place where you are capturing the dynamism of the near end of cycle or late cycle that you're talking about. It's something that other people have been talking about too. Are banks still leveraged to this economy, or are they independent? I'm talking about the biggest banks. Can you get long banks even if you see some sort of downturn in the near future, simply because they can capture the upside from higher rates? And they've been insulated from losses to such a degree with a lot of the regulatory action.
Well, Two things are important here. First, absolutely, the banks are still leveraged to the economy. Because bank lending standards have been tightening, because they expect the economy to slow over the next several quarters, you do see revenues starting to slow. That's because loan origination is down and the cost of deposits is going up and the competition for those deposits is going up. For the big banks, though, and this is the second thing, they're diversified. They have fortress balance sheets. They have a lot of ability to navigate cycle dynamics as differentiated from smaller and regional banks where that scale is less beneficial.
How much are you concerned about potential paper losses from bond yields rising as much as they have and the volatility that we have continued to see? Have we seen the fallout from that? Or is there something that sort of feels ominous about what we've seen?
Well, the reality for the banks is that the Fed's term lending program is still intact and will be until next March. And frankly, if long rates are still high, as I expect they will be in March, that program would be, I think, likely to be extended. And so paper losses in terms of a risk to the broader equity market are not on the list. They're not a concern. Where they do play a role is in capital considerations for the banks. And that's, of course, something that we're going to be hearing. Well, maybe we won't actually hear so much about it yet today because the banks don't really know what they're going to look like. But that's an area where we expect to see some continued hemming, hawing uncertainty. One thing with respect to capital and increasing capital regulations for the banks is there is a bit of a point here in that capital is so important for the security stability of the banks. It's one of the reasons why the big banks are able to navigate these dynamic forces that we're seeing in the market. But what we saw in March was a lot more about liquidity. And so I'll be curious to see what the banks say about that balance of fortress capital amounts and then the liquidity of that capital in the future.
We've seen a lot of volatility in the past couple of weeks. Have you changed anything about your views?
Such a good question. We're vigilant in navigating the market, but I think the reality is until we hit recession, we are probably not going to see a definitive macroeconomic narrative driving the market. And as a macro person, what that means is this is a time to be thinking about quality, essentially hand things over to the stock pickers, hand things over to the bond pickers, and acknowledge that sector or style plays are unlikely to last more than a few days at a time when there's so much uncertainty.
You say you're encouraging investors to be very pragmatic and kind of stable at the moment while they look around what's going on geopolitically. What did you learn from Russia's invasion of Ukraine that potentially you want to keep in mind when we watch these events unfold in Israel?
Well, the number one thing that investors, I think, felt in real time with Russia and Ukraine is that the initial shock, the initial assumptions that are made about a geopolitical shock or narrative aren't always what drive the market in the medium and longer term. So the first couple weeks after the invasion, you saw proximate asset classes seeing the most impact. The Russian ruble, Russian equities, oil, some food commodities that we knew were relevant in the region. But 2 weeks later, the most impacted asset class was the German Bund. And that's because the narrative around the invasion became one of inflation, one of a broader global picture that geopolitical risk was entrenching rather than just that initial shock of oil. And we've seen the same thing this week. A little bit of a bid in oil prices on Monday that's reversed a bit as markets step back and assess, okay, what really are the implications of what we're seeing in Israel to the region? So far, there hasn't been a meaningful impact to energy supply, and I think that's why we've seen some relief of that story. And then again today, with concerns that there might be an escalation, of course, the geopolitical picture changes. But there do tend in these shocks to be a stronger narrative that becomes clear. We just have to wait a little bit and see what happens.
And markets tend to be very patient. Lauren Goodwin of New York Life Investments, thank you so much for being with us. If you are just tuning into the program, the S&P is basically unchanged as we kind of fluctuate here. But now we are moving up 0.2%. We are seeing that yields now are down 11 basis points on the 10-year for 58.56. We are getting some headlines from the JP Morgan conference call with investors. Still with us, Sonali Basak, going through some of what we're hearing. What are we learning, Sonali?
We are learning that he is still criticizing regulators. We knew that this was going to be happening, and we've been talking about this storming of the Hill. The banks are really fighting these capital requirements, this new Basel III endgame requirements. And as we know, those big banks, they're not going to even be impacted as much as those smaller banks. That is a big part of the story here. I've been looking back through his prior prior comments as well, this idea of how much things can get worse. What's interesting is this is the best third quarter that Citigroup has ever had in rates and currencies. If you look at that at JP Morgan, they beat on expectations, remember? But the value at risk being a little lower, Lisa, is telling you something about the risk appetite within these banks as the economy starts to get a little choppy here.
We will get a little bit more, or much more detail coming up with you. Anne-Marie, from your perspective, is there any appetite in Washington, D.C. to divert focus to scrutinizing banks more, given the fact that they need to get leadership and deal with a whole host of other
Well, it depends who you ask. But to Shonali's point, Jamie Dimon has been talking about this for months. When Michael Barr came out and talked about stricter capital requirements, he said, great, this is a win for the hedge funds. This is a win for Apollo. This is a win for, and private equity firms. So this is a concern for the banks. But at the moment, the Fed looks like, and the regulators look like this is what they want to do. Because how do you have the past 6 months, we had 3 bank failures, and not act?
Right, especially with smaller banks, which might have the harder time actually developing some of the capital. Coming up, we will dissect some of these headlines, including the CFO of JP Morgan saying the pace of buybacks likely modest on capital proposal. Basically, modest is the word of the day when it comes to share buybacks, yet they will continue.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
One scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth, particularly if there's loan growth.
That was Ken Leon, Director of Equity Research at CFRA, after JP Morgan posted yet another quarter of net interest income that breached records, $22.9 billion in the third quarter, raising their expectations for the full year forecast. Similar type of move from others as well, and we are seeing that play out in the stocks as we see equities do better, especially in the banking sector. You can see JP Morgan Chase shares, which once were fluctuating about, now 1% higher as people parse through the results and get a sense of how much better. Also a sense that we are going to get share buybacks, although modest seems to be the word of the day. Wells Fargo shares up 2.7%, a beat across the board. Really, again, it's loan loss provisions that are lower than expected. It's net interest income that is higher than expected. It's banking revenues that are higher than expected. Fixed income trading revenues that are higher than expected. Equity is the weak spot, and yet still the incredible strength is leading these shares higher. Citigroup shares also up 2.7% on the heels of this. Anne-Marie Herdern here with me. John's off preparing for the 9. Shonali Bosick has been parsing through the numbers, listening to the call for JP Morgan because she can do everything at the same time. And I'm wondering if there are any larger takeaways before we dig into some of the details from these earnings that we can kind of draw a conclusion on with respect to the banks?
Yeah, there's one thing that JP Morgan says that I think is very important in terms of caution for the industry that is so excited that things aren't so bad today. And he says these results benefit from our over-earning on both net interest income and below normal credit costs. What does that mean? Don't expect this to be normal per se. He raised his net interest income at least 3 times. There's a debate if it was a 4th time this year. And can you imagine to that many times say, we're going to make more money, we're going to make more money, we're going to make more money, and we're going to make more money.
Well, okay, but here's the thing. There's a bigger takeaway here, and John was asking this earlier, which is how much is this PR? And basically saying, don't look at us. We're not expecting to make this money. It just keeps coming through the door. Or is this something that is some sort of tea leaf of what they expect to come, and saying to regulators and saying to others, hey, it's not so great. We're not really making bank. It's just sort of a quirk of the moment.
There is a little bit of balancing here. Remember, they are taking to Washington again soon in early December. You have the big banks that will be facing lawmakers at the beginning of their annual grilling. I love listening to this one because they are making pretty stunning profits in this environment. But you know, they can also say, this is the U.S. consumer. This is a good thing. The consumers want to borrow. They're still spending money. You are seeing some normalization. You look at Citigroup, the kind of the spend here starting to normalize. These are things that show you things could start to turn a little bit here, but the strength of the consumer is keeping the banking industry strong, plus the comeback of these institutional businesses that are aided by these very complicated dynamics in the market.
They're going to really push back on potentially future bank capital requirements, aren't they, when they come to Washington?
There's going to be 2 objectives. From the banking perspective, they're going to be pushing back against those capital requirements. From the lawmakers' perspective, there's all sorts of other issues. Why aren't you lending to my constituents who want to buy a home? The housing market is still in dire straits in many places in the country. There's going to be that constant push-pull on ESG matters, especially with this concern about energy security around the world. There's also going to be a lot of questions about headcount, because besides for JP Morgan, most of these other banks are cutting jobs, not adding them.
One thing that you really should need to know about Washington when there's hearings like this is actually, you think lawmakers in the room listening to every question, listening to every answer. They're actually not. They come in, it's very performative. They decide the point they want to make, potentially try to embarrass an executive, and then they leave.
Don't you just kind of want to go down there and buy them all a drink after? Like, it is such a long day. But, you know, speaking of long days, this sets us up for next week too, doesn't it? Because we do have Goldman Sachs, Bank of America, and Morgan Stanley starting to come in. Remember, what's interesting, a lot of money, yes, the consumer's holding up. The economically sensitive parts of the economy, as you see at Wells Fargo, auto lending, homes, still under pressure. But when you look to Bank of America, Morgan Stanley, these are wealthier client bases that we're looking at here that are borrowing for homes and still able to spend at maybe a greater scale than you're seeing at the weaker parts of the economy.
One thing that the JP Morgan CFO said on the call was that, as you mentioned, the full year net interest income guidance was up on, as you mentioned, Shonali, slower reprice. Does this basically just mean that they are not passing it along as quickly as they thought they would be to depositors?
And this is where that big versus small question comes into play again. JP Morgan is not passing it on as meaningfully as some of the smaller banks, where, you know, Jefferies in particular puts out this great chart about just how much deposits have repriced, because across the industry, they certainly have, just not at the biggest of the big banks that don't need your deposits.
So at what point does that become some sort of rallying cry? If you're getting so much money, why don't you pass it along to some of your clients that you have? At what point does that deposit beta play a role and really come under focus?
And it's also that question for consumers. Do you park your money in a JP Morgan where you know your money is safe, too big to fail, right? Or do you park it at a smaller bank where there could be some more worries, as we've seen earlier this year? Those smaller banks are getting a bigger rate, a better rate on your deposits. But to your point too, this has been highly politicized. The bankers have been directly asked, where is this money going if we're raising interest rates and you are not giving that money back to consumers?
Which raises the question of modest buybacks. And modest has been the word of the day. It's sort of, you know, something that we've seen as a theme in a lot of the banks. How much are we going to see in terms of buybacks? What will count as modest enough to satisfy investors and quell concerns by regulators?
It's a great question because the banking investor story, I don't know that it's hinging necessarily on those buybacks. They just want the numbers themselves to get better. But to the point you're making also, you can't sit there and return a ton of money to investors when you're laying tens of thousands of people off at most of these banks, right? The expense story and the use of capital is a massive tension and only getting more so by the day because wage pressure still exists at these banks too.
There's also a big theme, especially as we head toward Morgan Stanley, Bank of America, and Goldman Sachs next week, about why equity trading revenues disappointed and fixed income revenues beat. Do you have a sense of what was behind it? Is this a theme for the industry, or is this an execution issue for both Citigroup as well as JP Morgan?
There's one big tell that shows you that this is a theme for the industry. You had three of the biggest investment banks in the world, Goldman Sachs, JP Morgan, and Morgan Stanley, on the Birkenstock IPO, and the IPO whiffed. And so that is a really big problem for the IPO market. This lack of equity issuance, this real scarcity here makes it tough to keep equity trading live in terms of fees for the banks. But, a little inside baseball, that Goldman number versus Morgan Stanley next week is the talk of the town. Goldman has been leading on financing the big hedge funds and trying to win that business. Leverage, while constrained, is still alive and well.
Sonali Basak, thank you so much. We'll be catching up with you throughout next week and throughout the day ahead. And of course, we're going to get those earnings from Bank of America as well as Morgan Stanley and Goldman Sachs next week. Anne-Marie Hardern, first, I just have to say thank you so much for being with us this week.
Thanks for having me.
Because it's always wonderful to have you. It's also such a pivotal moment down in Washington, D.C. and just globally. And I'm wondering what you're looking for, just sticking domestically for the moment, to understand whether we can create some sense of order in terms of even nominating somebody to take over from Kevin McCarthy as Speaker of the House.
I think it's pretty obvious the Republicans at this moment are struggling to coalesce around one name. Steve Scalise, who had the majority in conference, couldn't get to 217. They can only lose 4 votes. And at some point, if this continues to drag on, you have to think, is there going to be a centrist that comes out and says, I'm just going to reach across the aisle, give the Democrats something they want potentially in a ruling coalition, and then we have to get a speaker, and we have to move on.
You mentioned about the bank hearings on Washington, D.C., and you can see that, actually. Any video shows that people come in, they make a point, they say something, they clip it, they put it on
Very
Instagram.
Performative.
Right, they put it on Instagram, and then they go home. And there's a question of whether Washington is losing relevance and whether they understand that. Do you get the sense that people are watching in Washington the perception and some of the market moves in response to what they're doing?
They watch perception, I think, more to their constituents back home. Obviously, they're always concerned about what happens in the markets if you're on the Financial Services Committee. But I would say that while, in New York, people will ask me, well, why can't they just get this done? It's just not how Washington works. Someone in New York, they're thinking in a pragmatic way. I want to get to a bottom line. I want to maybe make money. That's not how D.C. works. Things just take a lot longer.
Which is the reason why a lot of policymakers are getting together and trying to figure out whether at least maybe internationally they can coalesce around something. And that is why Tom Keene is in Marrakesh, ostensibly, although we will be hearing a fantastic panel that he has coming up at 9 a.m. Tom Keene is sitting down with the IMF's Gita Gopinath, ECB President Christine Lagarde, and the WTO Director General at the IMF meetings in Morocco. You can watch the conversation in its entirety on Bloomberg at LiveGo. Right now in markets, we could see a little bit of a positive momentum as we see better than expected bank earnings across the board. 0.3% gain on the S&P.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight, and manufacturing labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make make yourself sexy.
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. Your equity market positive on the S&P by 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, JP Morgan kicking off earnings on Wall Street. The Treasury market suffering from indigestion, with crude rallying on Middle East tensions. We begin with the big issue, the 30-year penny stock.
In terms of the bond market,
these sort of day-to-day moves are quite astounding.
A lot of this is whipsaw.
It's not just been the bond volatility of the last 7 days. It's really been the bond volatility of the last 3 months.
There's been such an incredible move in yields, particularly over the last month.
We've seen this huge repricing in long-end yields, whether you look at 10-year Treasuries, 30-year Treasuries.
When things move this quickly over short periods of time, there's unrealized losses.
There's still some concerns of weakness in the economy, still some concerns about international stability.
The situation in the Middle East is very volatile.
It is one more catalyst for volatility.
Over the medium term, it is, we think, inflation that's going to be underpin market direction. If it comes back,
that in itself is going to be another support for yields moving a little higher. I'd like to see them settle.
You're going to see the trend towards lower yields in the early part of next year.
The market is just trying to find this equilibrium right now.
It could be a volatile period.
I do expect this ongoing volatility.
The volatility this week has been immense. Joining us now to discuss, I'm pleased to say, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, wonderful to catch up with you, sir. It always is. Let's go through it piece by piece. The last 4 sessions. Tuesday, the 30-year yield down by almost 14 basis points. Wednesday, almost 14 basis points. Yesterday, up 16. This morning, down 10. Mohammed, what on earth is that?
It's lots of things, John, and thank you for having me. So the easy answer is Monday, Tuesday was about dovish Fed statements, lower yields. Wednesday, Thursday was about somewhat hotter than expected inflation, higher yields. Today is about geopolitical concerns, lower yields. So that's the easy answer. The harder answer is that we have lost all anchors to the bond market, all of them. We've lost the economic anchor, we have lost the technical anchor, and we've lost a policy anchor. So what we're seeing is this enormous volatility. So far, We are lucky in that when we have overshoots, it triggers some sort of reaction. If yields go too high, some people start wondering about locking in higher yields for longer. If they suddenly go down quickly, those who have been caught offside with massive positions, loss-making positions, take advantage of that. So the good news is there is a certain amount of range-bound dynamics, but nevertheless, this sort of volatility is simply indicative that we've lost all anchors for this bond market.
Well, let's talk about another anchor we've lost and another situation as well. Yesterday was a two-part story. You're right to point out CPI, small upside surprise, yields start to drift higher. Then we had this really soft 30-year auction in the afternoon. Mohammed, if we'd also lost predictable sources of demand when we get supply from the Treasury?
Yes, we have. And we're facing higher supply from the Treasury. So the most important buyer, the non-commercial buyer, the Fed is out. The Fed is a seller. That's gone. And don't underestimate the importance of a non-commercial buyer that buys in very big amounts and that is predictable. So the Fed is gone. There's questions about overseas buying. Japan, China. Big question marks, especially about China. And then there are the traditional buyers who have been caught offsides by buying too much when rates were artificially low. So there is a real question out there about who's going to buy this additional supply. And if the economy does not weaken, then the path of least resistance for yields is higher.
As things stand, Mohammed, then, does this compromise the Fed's approach to monetary policy?
Look, the Fed's approach to monetary policy has been compromised for such a long time. The minute you're late and the minute you mischaracterize inflation, you then have to go faster, and then you accelerate these dynamics that are taking place. So it certainly complicates it. I think there's a lot of question mark about this narrative that has settled into the market. Don't worry, the Fed will have to do less because the market's going to do more. It doesn't quite work that easily. But it is a very complicated policy outlook. You know, there's a nice warning today from Bank of England governor. And he's been talking truth to the markets over and over again, whether it was during the LDI, whether it was the impact of inflation. And he said, look, don't get carried away. This is very, very finely balanced. They had a 5-4 votes, and he says, I expect this to continue to be finely balanced going forward.
Well, Governor Bailey had to deal with his own financial instability issues last year, as you indicated. Do you think the budget deficit in Washington, D.C. presents a financial stability risk?
It presents a macro risk, and that in turn, if it's not well internalized by the market, could be a financial stability risk. The major financial stability risk right now is the unusual volatility. It tends to break things. That's what we've seen in the past. So far, the financial system has been incredibly resilient, and we should all be thankful for this. But this volatility, John, is not something you should sleep well about.
So, Mohammed, let's work through this together. Look at the yield curve right now, 2-year out to 10-year, negative 40 basis points. There is a theory that investors at the moment are unwilling to take on less yield on longer-dated maturities because we're still in a quite robust expansion. So either the curve needs to re-steepen to attract those buyers again in an expansion, or we need to go into a recession. Is it one or the other that ultimately solves this?
John, I can sit with you here, which I won't, and give you a number of potential outcomes, because neither the journey nor the destination is clear. Okay, the destination is not clear. There's significant disagreement about what's the equilibrium interest rate. There's significant disagreement on what will the economy look like over the medium term. That's the destination bit. On the journey, there's significant disagreement on how this journey will evolve. What will be the impact of QT, for example? We don't know what the lagged effects of all these rate hikes. So the problem that we're all facing is that both the journey and the destination are in play, and therefore it is very difficult to make a clear statement on what this curve is going to look like with a high degree of confidence. And you're talking here about the most important market in the world. This is the benchmark market for not just U.S. financial assets, but well beyond the U.S.
with tons of volatility as well. This is where the liquidity is meant to be. This is where you're meant to see signs of stability, and at the moment we don't see many signs of that. On QT, Sonali Basak, Jamie Dimon at JP Morgan, he talked about QT, talked about higher rates. That bank's still doing better than good.
They're doing better than good in the sense that they have raised their net interest income expectations for the fourth time this year, if you can believe it, John. You are just making so much more money on loans than you were before, not only because of First Republic, but they have their CFO saying the economy is surprisingly strong. That includes the labor market, and therefore card balances are doing quite well at JP Morgan. But even over at Wells Fargo, you are also seeing net interest income expectations higher. And so the banks are making money off this higher interest rate environment. Those worries starting to abate about those dangers of higher interest rates for now. But as you say, Jamie Dimon comes with that worry. Part of that worry is about the Treasury market. The quantitative tightening effects have not yet been felt. You had JP Morgan really fighting the impacts of further regulation for the big banks moving forward. Remember, many of the banks have already warned that that could create even tighter conditions for Treasury markets moving forward. But for now, all is quite rosy, both on the consumer side and on the institutional side. You have JP Morgan and Citigroup beating on fixed income expectations so well, John, that Citigroup is even having the best third quarter in rates and currencies in the past decade. So global market volatility helping out the banks here, while some investment banking figures start to come back, but a lot of caution under the surface.
Sonali, thank you. We'll catch up with you around the open and bound. Sonali Basak down the latest on Wall Street. The big banks, JP Morgan, Wow, Citi reported already this morning. Coming up later next week, you'll hear from Bank of America. Yields are lower this morning by 10 basis points. Your 10-year right now about 4.59. Mohammed, I want to come back to you. Big test for this bond market for me. When the data sours, are we still going to buy treasuries? That's the story for me in developed markets. That's the real test of a developed sovereign bond market. When the economic data gets bad, are we buying treasuries? Mohammed, are we?
I don't know, John. I really don't know. Normally you would say yes without even thinking about it, but there's massive supply coming. There's a step increase in supply coming. That's issue number one. And the traditional buyers are no longer there. So it's not clear. We should, by the way, draw a lot of comfort from the bank results with an important qualification. We should draw comfort because it points to resilient balance sheet. It points to resilient deposit base, and it points in JP Morgan's in particular to really good management. The qualifier is those banks were never the worry. It was the smaller banks that were the worry. And we should keep a close eye on those earning releases, in particular, the stability of deposits, what NIMs are doing, and asset quality issues. And that's what certainly I'll be focused on as we get more and more bank earnings releases.
Do you think we've left the stress of spring behind us? Is that behind us?
It's not clear what it is, John, because we've had another move up in rates. So we just need to keep a closer eye on this. It is very good news that the large bank, the globally systemically important banks, are doing so well. But it is not, they weren't the concern. The concern are the smaller banks. In fact, the larger banks may suffer because the reaction is going to be to increase capital requirements across the whole banking system. But keep an eye on the smaller banks. We're going to learn a lot in the next few days.
Mohammed, just a final word on the Fed if you can. Front end seems quite anchored now by the recent Fed speak we've had from the Federal Reserve, indicating that maybe November isn't going to happen. Is December still a live meeting for you, Mohammed, going into year end, given the inflation data we've seen so far this week?
John, the market says there's over a third probability that one of the two meetings is live. I hope it's not. I really hope it's not. But you know that I say that because not only do I worry about the lagged effects and the financial stability and growth effects, but I also do think there's a danger in trying to get to 2% too quickly. And if you look closely at the CPI numbers, and if you look at what's happening over the last 3 months, and if you look at the components of that, you will see why it is. Inflation has migrated in such a way that to get to 2%, you may end up crushing the economy and risking financial instability. So I hope they don't move either in November or December. I don't know what they're going to do. But behind that is a view that I know is not shared publicly yet by the Fed, which is we need to revisit the monetary framework. We need to revisit what is the right inflation target and how fast do we get to it.
And whether they'll ultimately tolerate higher inflation through next year and beyond. Mohammed, always a privilege, a pleasure to catch up with you, sir. Good friend of this program, good friend of mine, Mohammed Al-Arian, on the latest in this market. Here's the latest right now. Equities on the S&P 500, slightly positive. Let's get you some movers. Here's Abby.
Well, John, we, of course, had Shanali cover the banks, which right now are rallying on the solid results. So let's go elsewhere. One stock that's rallying for the wrong reason, Dollar General, or at least the wrong reason relative to the old CEO, Jeff Owen. He is stepping down, so the stock is up 7.3% amid workplace safety concerns. To the downside, though, Netflix is down about 0.8%. This as Wolf has downgraded on full ARPU expectations. Basically, the stock doesn't have too much more left there. And then Boeing down 2.2% as it's been revealed that one of its top suppliers, Aerosystems, that they're continuing to have supply issues, production, that max production issues, that it's worsening. So Boeing is down 2.2%, John.
Abby, thank you. The opening bell about 17 minutes away. Much more on some of these movers, including the big banks around the cash open with Shanali Basak. Let's turn our attention now to Marrakesh, Morocco, the IMF World Bank annual meetings taking place where my good friend Tom Keane is holding a special panel including ECB President Christine Lagarde. Let's take a listen.
I want you to touch on migration here, but it outlook that you see out 5 years and the prescription Europe needs to do now?
Well, thank you so much, Tom. And let me first of all regret but fully understand and appreciate why Kristalina is not with us, invited by His Majesty to attend the opening of the Parliament of Morocco. I think is a great honor and should just reverberate on the quality of the institution and, if I may say, its depth and the depth of its bench, because it gives us the pleasure of not having another man, excuse me, but having another woman. So that's a real test of success.
You're looking at me. Okay.
You're okay. All right, back to your question, because that's what you really want to hear from me. I would like to pick up on where Gita was and to tell you how we are seeing the situation now. And I put really the emphasis of now after the 3 mega crises that we have gone through in the last 3 years and the most recent developments that we haven't seen the end of and which will have, in addition to the human toll and the horrible developments that will take place, that will have economic consequences. And it feels very much like, and I want to point to my notes because I listed them and I want to mention them for you, what I would call the multiple moving parts. And we're just not yet too sure where the chips will come down. And I would list in my moving parts the unwinding of large previous shocks. And Ngozi has alluded to some. There are multiple previous shocks, from the disruption to the supply bottlenecks, to the immense volatility of energy prices, to the pent-up demand against the restricted supply, and all of that happening in a very abrupt and sudden way. So that's number one. Number two, something which is affected by lag time, or time lag, whatever you call it. And I'm not here talking about monetary policy. I'm here talking about the adjustment of wages to inflation. And there is clearly in everybody, in all central bankers' mind, the fear of the second round effect. Is it happening? Is it likely to happen? Are we at the peak, and are we now going to see declining wage increases returning to real wage a la pre-COVID? Question mark. That's another moving part. The third moving part is what I would call the strong. You know, we did 450 basis points hike in 15 months. Which is a huge, unprecedented increase. And this is what I call the strong but lagged policies. We haven't seen the end of it yet. We're seeing tightening of financing conditions like it has never happened before. We know that there is some more in the pipeline, and how it is going to impact our economies, how it will have deflationary impact, disinflationary impact in our region is also to be seen. And the final one, sort of really ball in the air, is the structural reforms that will come out of all that. There is what, Ngozi, you called the, did you say re-globalization? Mm-hmm. I would call it probably consistent with a good fight against climate change, the near-shoring, not reshoring, not friend-shoring, but reducing the distance, having a better handle and control over your supply chain and the logistic and transportation. That's just one example. I think the labor market is also a case in point where we will be seeing structural reforms and where the people who are joining the market now have different aspirations, different expectations than what we had, but let alone the two grandmothers at the table here. All of you, the Z generation, will not want the same thing. So those are all these balls in the air. We're not exactly sure how they're going to land, but certainly we all have to focus on our policies as far as the European Central Bank is concerned. As I've said before, our aim, our mission is to return inflation to 2% medium term, and we will. And it is happening as we speak, and we will hang on to that, be steady, long enough, and ready to do more if necessary.
This sets up Joyce Chang perfectly. President Lagarde, and I say this with great respect for Bill Rhodes for years at Citigroup, do you ever feel like you're central banker to the world? I'm talking to you, Christine.
Oh, to me?
Do you ever feel like you're central banker to the world?
Central banker
You bring it over from the ECB over to the major central banks, feeling like they have a profound effect on EM and the rest? You talk about the monetary policy movements that we saw.
Look, I think central bank governors, presidents form a community. They're all driven by the same purpose. They have different mandates eventually, but I think their mission is to procure or restore price stability so that economic actors of all sorts, consumers, investors, savers, spenders, can actually anticipate what is likely to happen. And we have to do that in intelligent coordination with the fiscal authorities.
Right. Joyce, I'm so happy you're here. You gave us a bond market that we don't want to talk about. We're doing a debate on the global economy. You have a framework with Bob Michael at JP Morgan of a 2.5 inflation-adjusted 10-year rate, of a 5.5 10-year yield out at some point. For those of you not versed in the world of Joyce Chang, that's stressful. And you and I talked about Barry Eichengreen's paper at Jackson Hole, which is a debt walkthrough of EM. And I'd like you to fold the constraints we have on getting to a more optimistic and better growth over to the challenges that we see with emerging market debt.
No, thanks so much, and it's just wonderful to be here with you, Tom, and with Gita, Christine, and with Ngozi. Well, we do think that the great moderation is over. We had put out a target, 2.5% real yields. We thought could be a sort of a medium-term target. Take 5 years.
Oh, her mic is off. Okay, well, we expected this. There you go.
Oh, okay. I'm sorry. Is that better, everyone?
That's much better.
Okay, great. No, so I think part of the problem, Tom, is the bond vigilantes are back. The great moderation is over, and the focus has come back to the fiscal and debt sustainability, and there's actually more talk about that at some of the market meetings than even about the soft landing and no recession scenario. And so I think the cost, there's the resilience, but then there's the cost of that resilience that's really coming into market focus right now. So when we put out, real yields, we think there'd be 2.5%. We were at -1%. And people ask me, how long do you think it could take to get there? I said, well, maybe 5 years. But, we're practically there already. And I think, this is kind of coming at an inconvenient time. You have the 30% increase in Treasury supply on long duration at a point where, the Fed's not buying, the banks are not gaining deposits, the institutional demand isn't there. And that has very clearly put the focus back on the debt dynamics, the debt sustainability, and the fiscal debt and the cost of servicing the debt, given the size of the fiscal deficit. And the focus isn't on the emerging markets so much as it is on the advanced economies, particularly on the United States right now. I mean, in this period, I think EM has been, very resilient. But we've also seen limping along. I, fractured my foot, so relate to that. The limping along as well, where the medium-term growth, does not look as optimistic. But we are, once again, getting a focus back on whether the financing is going to be more problematic. And it's hard to talk about emerging markets in one block because there's clearly the frontier market countries, and then there is the EMX China, the middle income countries, which have done a very good job. They started hiking a lot earlier. We think there's probably 150 basis points of easing they can do between now and the end of next year. But you do have the debt dynamics that are very much back in focus, and the debt service. But that's not just an emerging markets problem, it's an advanced economy problem as well.
It's interesting. Gita, I want you to fold this in. And Gita well knows there's the blue book, the green book, the brown book, and I wish you'd print them still instead of just digital, because I actually love the appendices and all this, the great work of your team at the IMF. But I'm going to go all Tobias Adrian on you right now. I listen to what Joyce is saying, and I listen to what I see on the Bloomberg screen. And the bond market is speaking about this growth constraint we have. On a Hayekian basis, how do we clear this system to move on to a better place?
So, Tom, the bond market is reflecting many things. For one, it's come to accept the fact that interest rates will have to be higher for longer, something policymakers have been clear about, but it's taken some time to get into the market. But the other aspect, and this is the novel piece that Joyce pointed to, is we are seeing some pricing in of fiscal risks, which is usually unheard of when you think of the US market. You have a large amount of debt being issued at a time when you have quantitative tightening being done by central banks, at a time when Japan's rates have gone up, and therefore their demand for US Treasuries are somewhat weaker. In that environment, what we're seeing is pressure on yields at the long horizon. Right? So right now there is a huge demand for cash, which is on the short end of it, but we're seeing a lot more volatility on the long end. And I want to take that to a kind of step back and make a broader point here, which is that if you look kind of around the world, it's particularly true of the US, but many other countries, we're seeing a looming mismatch between the spending needs of countries and the resources that they will have to pay for it. Now, there was a decade after the global financial crisis when that was less of a problem because you could borrow at ultra-low interest rates, and that was not an issue. But now you're borrowing at much higher rates, and you have weak growth prospects. So this is a difficult place for countries to be. There's a challenge, particularly for emerging and developing economies who have important development goals that they have to meet the climate transition. But I think it is an important time for governments to think about how they're going to pay for all these spending needs without relying as much as they did on borrowing.
And Ngozi, I look at this and I look back at your wonderful article in Foreign Affairs. I can't say enough about it, folks. And there are these phrases from another time and place, GATT, most favored nation status. And now we have, as you write about, almost a blockism from pre-World War II. What is going to be the process that WTO can provide to get us to a better place? Here in Marrakesh, I'm very much listening for the processes recommended to jumpstart us out 5 years to better trade situation. What would it be?
Well, thank you, Tom. I think the one thing we don't recommend, let me start with that, is more fragmented trade. Because if we have the world, if we have trade fragmenting and people just trading with each other in blocks of people similar to themselves, this fragmentation, we've done some work, Gita and the IMF has done some work that shows that the real losses to real GDP, global GDP in the long term are substantial. 5% in our case, they had 7%. And for emerging markets and developing countries, it would be in double digits. So and I will not stop saying this, it will become boring because we think that any fragmentation, if fragmentation spreads, then definitely we will not be able to get back on the good path. What I think we should look at to get us back in terms of trade, we need to avoid more protectionism. We need to avoid people retreating and thinking that, look, things are going so badly that I have to make sure that I rely as much on myself as possible. Because we've seen that global trade has rendered benefits in the long term. For the past 75 years, we've seen people lifted out of poverty due to trade. So let's not throw away what has worked in the past, but let's try and make it better. That's why we talked about the re-globalization. So let's avoid protectionism and putting barriers. The free flow of trade is what we need if we really want our economies to move. I think the second thing I want to say is that there are green shoots within trade, and that's what we're looking at the WTO. We look at trade, and even though, our recent forecast has downgraded the goods trade, the volume of goods trade from 1.7% to 0.8%, which is quite a dramatic downgrade and goes along with all the new pessimism that is emerging. But within that, there's something very interesting happening, and that is the growth of digital trade and digitally delivered services trade, which is growing at 8% per annum. Out of $32 trillion of trade, we've got 25 trillion that is goods, 12 trillion services, and of the 12 trillion, 4 trillion almost is digitally delivered services. So this is growing so fast. We're saying, what can we do to make sure that we foster this trade, that we make sure micro, medium, and small enterprises and women-owned enterprises that are the ones using this trade the most, that we remove barriers in their way, and that we put a level playing field so that this trade can grow even more. So that's the green shoot, and I think as we have all this pessimism, we should look at some of these optimistic areas.
With the time we have 21 minutes left, folks. I'm trying to get an extension right now. We'll see if we get that. Ngozi, I'm going to come back to you at the end of this effort to speak of the huge opportunity of trade within Africa, and particularly when I look at the span of the IMF here from Nairobi 50 years ago over to where we are now. Christine Lagarde, when I first met you, you had just been at LSE Square Dancing. It was a few years ago.
We'll let that conversation continue with Tom Keene speaking to ECB President Christine Lagarde. I want to get you set up for the opening bow, taking place in about 20 seconds from now. Your equity market on the S&P 500 positive by 1/3% on the S&P. On the NASDAQ up by 0.2%. The S&P heading towards a second week of gains, even with all of that bond market volatility. This bond market all over the place. Equities with a lift. There's your opening bow. Check out the bond market. Treasury yields shaping up as follows. Yields on a US 10-year a whole lot lower this morning on a 10-year, on a 30-year as well. The 30-year this morning, looking at my screen on the Bloomberg terminal, lower by 9 basis points at 476. On a 10-year, lower by 9 basis points to about 461. The move we saw in the 30-year yesterday was a whole lot higher off the back of CPI and a pretty soft supply coming from the 30-year auction as well. Looking at the FX market, a euro 105.23. We're negative there by 0.05%. Let's get to one sector we want to watch at the opening bell, the financials. Big bank earnings kicking off with JP Morgan, Wells, Citi, all delivering better than expected Q3 results. But JP Morgan CEO Jamie Dimon delivering a warning, writing, quote, "This may be the most dangerous time the world has seen in decades." Shonali Basak has more. Hey, Shonali.
John, good morning. You have on one hand the most dangerous time the world has ever seen, and on the other hand, a surprisingly strong consumer in the U.S. economy. And that is fueling JP Morgan and a net interest income that has been risen in expectations for the full year for the fourth time this year. Now, listen, when we listen to these conference calls that are getting underway here, there is a very measured tone, the risks ahead versus the opportunities today. And you do see JP Morgan still beating on most of the cylinders that it needs to be. Fixed income trading above expectations, net interest income remaining high. Yes, deposit betas might face some pressure here, but deposit pricing is still very competitive for a big bank like JP Morgan. Good point that has been made earlier by Mohamed Al-Arian, Bloomberg opinion columnist, this idea that the biggest of the big banks are not the ones that we're necessarily worried about. The regional banking system, as this continues on, are we going to see more strains in the consumer than we are seeing from the likes of JP Morgan and Wells Fargo? Because even at Wells Fargo, you are seeing fairly significantly calm markets when you look at the credit costs being associated by the loans being extended. The trends we're seeing in the economy here, this idea that commercial real estate, housing markets, auto markets are are the ones that are more severely impacted are certainly playing forward in the story for the biggest consumer banks. And for the biggest investment banks, both JP Morgan and Citigroup are not only beating expectations on the most important fronts, they're also telling you that things are starting to get a little bit better. Now, does that hold? It depends on how dangerous that economy gets. If things get stifling, everything could turn around. But you have the likes of Citigroup saying that debt underwriting is very significantly higher than what Wall Street expected, meaning they're raking in fees as institutions are willing to meet the market again.
Sonali, thank you. JP Morgan up by 2.5%. The broader market 2 or 3 minutes into the session positive by 0.4. On the NASDAQ up by 0.2. Let's stick with the banks. Baird's David George weighing in after JP Morgan results, writing this: while these were solid results, we don't expect a meaningful reaction either way on the heels of the print, given how crowded the stock is currently. He has a neutral rating on JP Morgan and outperform on Wells Fargo. David George, I'm pleased to say, joins us right now. David, always great to find some time with you when we start to get the bank earnings coming out. You said coming into it, the setup was compelling. Do you like what you hear this morning?
Yeah, we do. For all of the fears out there, John, around this bank so-called crisis, the earnings so far that we've seen have been quite good. JP Morgan made over $13 billion in the last 3 months, and Wells and PNC also had very good numbers. So I think what it shows, John, more than anything, is just the resiliency of these business models. And despite all the machinations of rates and credit and capital, the earnings stream and the revenue streams of these banks is actually quite annuity-like or utility-like in nature. So we feel pretty good so far to start these earnings season.
David, you know the concerns coming into earnings season. There were two of them. Loan growth was subdued, net interest margin moving in the wrong direction. Any reason to believe that turns around anytime soon?
So loan growth is going to remain relatively soft, we think, over the near term, and that's just a natural reaction function of higher rates, and that's the intention, I believe, of the Federal Reserve, is to slow economic activity broadly, and we're starting to see that. In terms of net interest income and net interest margins, we're of the view that we're within a 2 to 4 quarter period of a bottom in net interest income and net interest margin. And keep in mind, despite the fact that funding costs have gone up considerably as the Fed has tightened over the next couple of years and really the next 18 months, we think there's going to be fairly significant asset repricing in the form of loan yields picking up as well as securities yields. So there is a benefit that we think that the banks are going to experience, and the stocks are priced for permanent impairment and profitability, John, and that's just something we do not believe is going to happen, and the stocks, by and large, are way too cheap in our opinion.
Certain banks, as you know, are in the penalty box given what's happened with the bond market through much of this year. Is that what we need to get the likes of Bank of America out of the penalty box? A bond market rally? Is it that simple?
Well, I think that will certainly help. I mean, if you look at just what bonds are doing, banks tend to be, if bond yields are down, banks are trading up. So clearly, this OCI or bond loss fears are still kind of front and center in bank investors' minds. I think that will help to some degree. And honestly, a higher for longer environment for banks is actually pretty good. There's just a timing issue with respect to how quickly liabilities are priced relative to assets. And again, over the next few quarters, we think there's a nice opportunity to get some mean reversion, as it were, in terms of both ROEs, and net interest margins for the banks broadly.
Hey, David, we'll let you go. As always, thanks for carving out some time for us for bank earnings. Every quarter, David George there of Baird on the latest. Let's talk about that bond market. Trying to find some stability. Yields lower by about 8 basis points on a 10-year, 461. Broader market 6 minutes into the session. Equities up by 0.5%. With us now is Evercore's Julian Emmanuel, Oppenheimer's John Stolfers. Julian, I'll come to you first, buddy. I know that what we've heard from the banks is basically in line with your outlook. Right now is okay. Next year, I've got no idea. Julian, is that what you heard from the banks this morning?
I don't see how you can draw any other conclusion, John, because, think about it. They're raising their numbers for 2023. Some are not willing to give a great deal of guidance for 2024. And then Jamie comes out and makes that statement about the world being a dangerous place. And I think the environment where you see the banks ripping and you see oil and gold ripping together this morning tells you that the world is a dangerous place.
The world's a really dangerous place, John. We've been told that time and time again. But then this is what you hear. This is the reality of quarterly numbers from JP Morgan. The bank raised this year's net interest income forecast. Provision for credit losses, net charge-offs were less than expected. John, what should I pay attention to? The fears about the future or the better reality that we've had compared to expectations?
think, Jonathan, I think where we are today is the world is never a safe place. I've been in this business since 1983, and I think probably the best year we had was 2017, and people complained that there was no volatility at that time. But looking at it here, I look towards the future, but I think the numbers that we saw today show that the diversification of business, really terrific management, and the ability to access clients and help those clients makes good sense in the financial sector. And we think very much, I think your prior guest from Baird said it very much in our viewpoint, is we do think that things are actually getting better, even though interest rates are higher. We think the end of free money is a good thing. It's a much healthier environment.
John, for your bullish outlook to work, though, do you need bond market stability? And when I say bond market stability, I've asked this question this week so many times. Does that mean lower yields or just smaller moves?
I think smaller moves, John, and where we are today, we're beginning to see the bonds really trade in a range from a relative low to a relative high. And it says the bond market is looking ahead and figuring out that the Fed indeed is getting it right. Even though it is not infallible, its mandate is relatively simple. Yet it is a complex process to arrive at success, but it looks like it's doing it.
Julian, do you agree with that?
Yeah, absolutely. From our point of view, when you think about the long term here, earnings drive stocks in the long term. And there is a history of stocks going higher in an interest rate environment similar to where we are now. And basically, from our point of view, it's no coincidence that as much stress as there is in the world today, bond yields are actually lower on the week and stocks are high. That's a narrative that works.
There's some risk aversion out there through the week. It's not just the Fed speak, not just the data. There's some real risk aversion driving yields as well. I want to come back to something we heard from LVMH, Julian. LVMH essentially calling the top, the end of the post-pandemic consumer boom. And Julian, I know I say this with a lot of snark, but are they the canary in the coal mine from what we're hearing for the consumer?
So a company like that, there's no question about the fact that they have boots on the ground into the health of the consumer. And there's a lot of academic literature written about when that pandemic excess savings is going to wear off. We think you're still okay till the middle of next year. And if the labor market holds in, the consumer will go on longer. But confidence is very, very fragile, again, given high oil and all these crises we seem to be facing.
John Stolfus, has that pandemic era saving story played out?
Well, I think what we've seen is a much more prudent consumer than we've ever seen before. During the pandemic, they paid down some of their debts. They did spend, but they seem to be spending within reason. And I think part of that is that the consumer today is much more sophisticated just by virtue of all the information that just moves towards them on a daily basis. And you can see that within some of the negative positioning in terms of sentiment in the University of Michigan and Conference Board data that comes out. But yet in actuality, they continue to spend. They just shift their spending. Related to luxury goods, I think it's probably that there's just so much you can do within luxury space until you create a new excitement that brings out the luxury buyer. And also the effects of China's economy on the luxury market, I think, is really what is the big statement when it comes to luxury.
Julian, let's finish on energy. Brent crude up this morning by 3.5%, just short of 90. WTI up by about 3.5% as well, just short of 86. Wow. Julian, the focus there is about whether Iran is directly implicated for the massacre that took place over the weekend in Israel. How Israel responds to that remains to be seen. Julian, how are you and the team processing that, just in terms of the markets?
So what's interesting to us, and I think important to focus on, is that we've had extraordinary gyrations in oil over the last week or two, and actually going back several weeks. And at the end of the day, you're still range bound. Now, if you start breaking towards $100 a barrel, clearly that is more risk coming in to the geopolitical environment, and that is something that is likely to impact the consumer negatively. We don't see that yet, but obviously, next week is a new week, and what could happen between now and Monday, we'll just have to see.
Gillian, the unknown. The unknown. I'm with you. 2024. No one's talking about 2024 because we're absolutely clueless as to what is around the corner. Gillian, thank you. John Stolfus to you as well, buddy. It's good to see you. Have a good weekend, gents. About 12 minutes into the session, equity shaping up as follows on the S&P. We're positive by 0.5%. There is a rally in the bond market today. Yields are lower by about 9 basis points of 461. A rally in the commodity market as well. Brent crude 89, WTI around about 86. Coming up, a messy week for Treasuries.
We have lost all anchors to the bond market, all of them. We've lost the economic anchor, we have lost the technical anchor, and we've lost the policy anchor. So what we're seeing is this enormous volatility.
Tiffany Wilde of PIMCO up next.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
We have lost all anchors to the bond market, all of them. We've lost the economic anchor, we have lost the technical anchor, and we've lost the policy anchor. So what we're seeing is this enormous volatility. So far, we are lucky in that when we have overshoots, it triggers some sort of reaction.
Mohammed Al-Arian weighing in on the volatility this week. PIMCO's Tiffany Wilding looking ahead to the rest of this year, writing this. Markets appear priced for a benign economic outcome that would be a historical rarity given current conditions. Higher bond yields offer resilience amid increasing risk to the global economy. Tiffany, I'm pleased to say, joins us now for more. Tiffany, wonderful to catch up with you. It always is. You think both growth and inflation have likely peaked. What are the sources of demand, Tiffany, that you and the team think are fading?
Yeah, so this is something that's obviously been discussed quite a bit, but we had just amazingly large transfers from the government sector to the households and businesses, for that matter, during the pandemic, and that created just a very large, positive economic overhang that I think we're just still working through. So Milton Friedman famously said that monetary policy works through long and variable lags. Well, in this case, fiscal policy is also working through long and variable lags. But the thing is that higher inflation and price levels is eroding the real value of those, positive excess overhangs, and we think that they are diminishing, and, and the resilience that you're seeing in economies, that's set to fade. So we would be careful about over extrapolating that, and we think the markets maybe have, and they're just not pricing in a high enough probability of recession.
Tiffany, as you indicated, that positive excess overhang was a consequence of a major fiscal transfer from the sovereign balance sheet over to the consumer. Is that leaving the sovereign balance sheet in a precarious position?
Yeah, well, obviously government debt levels, are much higher. That's not only in the U.S., that's everywhere. And that's going to impact policy moving forward. And what that's meant to us, is just that there's going to be less room and less capacity, less willingness to, to implement more if, in the future as the economy goes into a downturn. And by the way, it's not only the federal government balance sheet or debt that's more elevated now, but of course central banks also have larger balance sheets. And we think there's probably going to be some fatigue there as well. So you're not going to see the type of policy response, that we've seen from the past two crises, the great financial crisis as well as the pandemic. You're just not going to see that in our minds moving forward.
So going forward, what do you think is the new reality? What are we going back to, Tiffany?
Yeah, so we've discussed, for several years now that this new reality that we're moving into, is somewhere different from, what economists called the Great Moderation prior to that. So we think we're just going into a more volatile world, and that's also being exacerbated by the fact that they're just secular transformations that are happening. We've obviously all talked a lot about the transformation towards renewable energy, but there's also transformations that are happening, geopolitically as well, right? And that's just creating a more volatile environment overall. So this is something that we're going to have to deal with, unfortunately, moving forward.
The Federal Reserve might have to try and deal with some of these issues as well. For the Fed, Tiffany, what we've heard so far from speaker after speaker is they're comfortable allowing the bond market to do the work for them. Does that mean November's no longer a live meeting for you and the team?
Well, I think it's a close call, quite frankly. The data that we've seen more recently has just been stronger. The labor market report obviously was very strong. And the more recent inflation report that we got yesterday, just kind of showed the underlying trends, these super core measures that the Federal Reserve is very focused on. They're just not going in the right direction, unfortunately. It's right that the bond market adjustment that we've seen over the last several months is tightening financial conditions, and that is doing the work for the Fed. But I think it's possible that the Fed might just want to take out some insurance and might want to try to lock in some of this additional financial conditions tightening with another rate hike. So we think it's ultimately a very close call at this point. But I think the broader issue here is at what level of of rates and financial conditions do we really need here to start to really cool economic activity and ensure that inflation's back to target. And I think the bond market and the Fed is still searching for that level.
Tiffany, it's interesting you say that, because all indications we get from the Federal Reserve is they believe we are sufficiently restricted. If we're not, we're only 25 basis points or something like that away from it. Would you push back against that?
I think there's just a lot of uncertainty right now in general. And as I said, there's a lot of economic volatility. The pandemic situation was obviously very unique, as was the war in Ukraine, for example. And just, the traditional economic models, are just not set up for that kind of supply shock. So, I think there's a lot of uncertainty. We agree monetary policy is restrictive. As I said, we think the probability of recession here is quite elevated. But there's some uncertainty around that, obviously. The Federal Reserve is dealing with that uncertainty by treading lightly, by going slowly. Now that policy is in restrictive territory, they're trying to probe for those levels of restriction that bring the economy more into balance. But again, we're not exactly sure where that is. And it's certainly possible that we haven't hit it yet. But on the other side of that, it's possible that we're already there. Monetary policy works through lags. And certainly we could come to a point where, the economy is slowing more than Federal Reserve officials expect. And it looks like policy is too tight.
Tiffany, thanks for the update from you and the team. Tiffany Wilding there out of PIMCO on the latest on the bond market and what we can expect from the Federal Reserve and the US economy. The broader market right now, 22 minutes into the session, higher by 0.5% with some sector price action. Here's Abby.
The breadth this morning, John, is excellent. We have many sectors trading up more than 1%. Utilities, energy, financials, healthcare, consumer staples close. However, those mega cap tech stocks, those sectors are just up ever so slightly. So the gain, while solid, isn't as robust as it would be if those sectors were also participating. On the week, though, all 11 S&P 500 sectors are rising. We are looking at a second up week for the S&P 500 in a row. And take a look at the banks. The S&P 500 Bank Index on these strong results, well, it is up 4.4% on the week. And that is the best week since July 21st. So a little bit of a comeback here for the banks, John.
Abby, thank you. Coming up next on this program, your day ahead, your trading diary.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
Heading towards another week of gains on the S&P, gaining here by 0.6%. That's the price action. Here's the trading diary. Coming up, you missed consumer sentiment at the top of the hour, plus President Biden speaking at 3:15 Eastern Time. Tuesday, earnings from Bank of America and Goldman Sachs. Plus, we'll get US retail sales. Wednesday, results from Morgan Stanley and Netflix. And finally, Thursday, Fed Chair Jay Powell leading a busy day of Fed speak. All of that in the week ahead. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, October 13th. Here are the top market stories that we're following for you at this hour. Banks deliver. Wells, Citi, JP Morgan report solid numbers, while Jamie Dimon warns of dangerous incidences. Dangerous times. Thank you, Prompter Scold. Consumer read here. We're going to get the latest read on confidence with Joanne Shu, director of the University of Michigan Surveys of Consumers, in just a moment. And risk tolerance, equities up, yields down, oil rally underway. We're going to see how much risk you should take on into a weekend of uncertainty. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, what do we got here with UMich?
Dangerous times. Certainly, that's what the consumer feeling right now. UMich drops onto our Bloomberg terminals. The headline number, 63.0. That's down from 68.1. The survey, 67. So that's a substantial miss. Current conditions coming through at 66.7. That's a big drop. Expectations dropped to 60.7. 1-year inflation, wow. 1-year inflation rises to 3.8, up from 3.2. And we have a rise in the 5 to 10 as well. I wonder if that's gasoline prices. But basically, the consumer is feeling more gloomy and inflation expectations are rising, Alex. That's not a particularly good cocktail heading into the weekend.
No, those numbers are not great at all. We are seeing the bond market not moving as much. We're giving up some of the gains that we saw in the Treasury market on the front end. So yields down by just 2 basis points now. But we're still seeing money kind of flow in. Equities go nowhere yet. But this is not a great read for how consumers are feeling.
Absolutely not. Jamie Dimon warning a little earlier on the call, talking about the fact that the consumer is working through the excess savings. We've been talking about that for a while, though. That has been something that has been going on for really quite some time. I just wonder what this is in reaction to. There are potentially a number of different catalysts, Alex, here. Gas prices, I wonder whether gas prices are the contributing factor when it comes to that inflation story. But the further out story, I don't know. Maybe the consumer just sort of mimicking what we're seeing at the long end of the bond market.
Yep. I don't know. So I think we should go to Joanne. Should we do it? Let's do it. Instant analysis.
We should, probably. I thought we were going to chat, but...
We did chat, but we want to know why. Let's ask the person who did the numbers. Joanne Shu, University of Michigan Surveys of Consumer Director. All right, Joanne, what is leading the decline in expectations? And then UMich inflation expectations rising. What's leading it?
Overall, consumers are feeling much more stressed out about inflation than they were just a few months ago. And this is largely being driven by increased concerns over not just gas prices, but food prices as well. I think think consumers earlier, in the previous few months, felt like that the increase in gas prices was possibly temporary. And now that it's been going on for several months, consumers are getting increasingly worried about the future.
In terms of what the implications of this are, can you just kind of walk me through what you think is going to happen next? If the consumer's feeling this gloomy, what are the implications for the economy?
I think the implications are not good because actually when you look at all the things that are happening in this country and also overseas in terms of labor strikes, war in the Middle East, and the resumption of student loan payments, there are a lot of things that are going on right now that could weigh down consumer attitudes and their willingness to spend. So given that, it's actually kind of surprising that consumer sentiment only declined by 7% this month. So I think there's a decent amount of downside risk in the months ahead.
So what I find weird is that if I just take a look at the daily national average gasoline prices according to AAA, they haven't moved. They've been going down. So I'm confused as to what that reaction is really to.
I think consumers might be a little bit confused as well. Well, not so much confused as they are unsure, because we saw the increases just a few months ago, August, July, and August, and I think consumers didn't react too much to it back then. But I think part of the reason was they thought it was temporary, and I think now that consumers are just what we're seeing over the last 4 months are increased spontaneous mentions of food prices and gas prices. So this is something that's not really limited to one part of the country. We're seeing this across the board.
Interesting.
Joanne, to what extent are we also seeing the impact finally of higher rates?
I think that's certainly part of it, but given how much how focused consumers are on the types of purchases that really affect their lives, I think it does make sense that food and gas are really on the forefront of people's minds. Consumers have noted the effect of higher interest rates on the purchases that they do need to do, for example, durables and autos. And so we're seeing consumers notice those higher interest rates. But in terms of, active, conscious reactions to interest rates, that's probably not this month's increase, but certainly the pass-through to consumers, that's certainly part of it.
I wonder, Joanne, how are people feeling about what's happening in D.C., and is it hitting their radar yet in terms of the House not having a speaker and the dysfunction there?
We are hearing that mentioned by some consumers, but I think also the House dysfunction is a continuation of what we were seeing over the last few months with the close call with the federal government shutdown. So I think consumers are absolutely frustrated at the dysfunction in Washington, and they're reserving judgment about how that's going to look going forward. Certainly, if a federal shutdown does come to pass, what we've seen in previous shutdowns is that consumers absolutely do react to that, and sentiment is likely to decline even further if that happens.
Joanne, one final quick question. It won't be captured by this data, but we've just seen the start of another major global conflict. Historically, how do consumers react to news such as this? We've seen the war in Ukraine, but now we've got the emerging conflict that we see in Israel. How would you expect the consumer to react to that?
I think that consumers will absolutely, their attitudes will definitely deteriorate if this conflict continues to escalate, and especially if this provides even more disruptions to supply chains or gas or fuel prices. It will certainly affect consumers and their attitudes towards the economy.
All right, Joanne, look, we really appreciate the instant analysis. Thank you so very much. Joanne Shu, University of Michigan Surveys of Consumer Director. Just to reiterate, sentiment dropping, expectations for inflation rising. That's sort of the net here for UMich in October. All right, coming up, our question of the day, if we just take a look at the market reaction, is it risk off into the weekend? We're going to talk to Megan Horman, Verdant's Capital Advisors CIO, coming up next. This is Bloomberg.
me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg.
In terms of the bond market,
these sort of day-to-day moves are quite astounding.
A lot of this is whipsaw.
It's not just been the bond volatility of the last 7 days. It's really been the bond volatility of the last 3 months.
There's been such an incredible move in yields, particularly over the last month.
We've seen this huge repricing in long-end yields, whether you look at 10-year Treasuries, 30-year Treasuries.
When things move this quickly over short periods of time, there's unrealized losses.
There's still some concerns of weakness in the economy, still some concerns about international stability.
The situation in the Middle East is very volatile.
It is one more catalyst for volatility.
Over the medium term, it is, we think, inflation that's going to be underpin market direction. If it comes back,
that in itself is going to be another support for yields moving a little higher. I'd like to see them settle.
You're going to see the trend towards lower yields in the early part of next year.
The market is just trying to find its equilibrium right now.
It could be a volatile period.
I do expect this ongoing volatility.
Those are Bloomberg TV guests weighing in on the volatile state of markets. And that really brings us to the question of the day. As equities give up some of their gains, money still flows into the long end of the bond market. Is it risk off into the weekend? Let's ask Megan Horman, Verdant's Capital Advisor, CIO. Megan, good to see you. Is it risk off right now?
It doesn't look like it in the market action today. However, we have seen the equities pull back from their highs after we got that University of Michigan Consumer Confidence Index. Again, it's a long day. We still have a lot more trading to go. I think there could be some fading of this rally into the end of the day ahead of the weekend, especially given the really pitiful number that we just got from consumer confidence. And then there's, the Middle East conflict is still front and center to most people's minds.
What does being defensive mean to you, Megan? If you want to be defensive right now, how do you achieve that?
Well, it's nice to be in cash right now, to have an overweight cash position. This gives you not only the ability to earn a healthy yield, but also you can take advantage of the volatility that we expect will continue for the rest of this year. Remember that we still think that there's a recession that's unavoidable, but there tends to be opportunities for the long run if you have dry powder to put to work.
Where? I guess what would be a trigger to put that dry powder to work that would make you feel like to make a safer investment?
Well, first of all, there needs to be some realistic, expectations from a valuation perspective. Valuations right now in a lot of the area of the large cap market, for example, is still high, given the expectation that the Fed, we think, still has probably one more rate hike in them. They're not going to be cutting anytime soon, even if the economy starts to weaken. They just don't have the ability to do that. Inflation has been very tricky. It has been stubborn. The Fed doesn't even really see, if you look at their forecasts, for inflation to get down to that 2% level until 2025. So anybody who's looking for rate cuts to come in and save the day, I just don't think that they're here. So we think valuations need to get much more realistic to that expectation.
Megan, to that point, former St. Louis Fed Chief Jim Bullard, he's speaking at the IMF meeting right now, talking about the fact that markets may be underpricing the risk that inflation resumes its rise, and the Fed might have to hike to 6, maybe to 6.5% if that were to happen. What happens to financial markets if that scenario that Jim's laying out comes to pass?
Well, that's where we get that 10% or 10% plus correction in the market. The market is simply not pricing that in. The S&P 500 PE is around 20 to 21 times earnings. When you're looking at an interest rate environment that is that high, inflation that's that stubborn, the PE multiples should not be trading at 20 times earnings.
So what do you do with something like oil, which obviously has a feed through in terms of inflation? It feels like today it's being treated as a safety asset, as sort of like a hedge the geopolitical risk, maybe I can say. So what do you do with that and then energy stocks that have been outperforming?
So we're not dumping money into energy stocks. I think that they've had a nice run. Instead, some of the sectors that we would focus on is those, like you had asked, the defensive sectors. So it's healthcare, staples over discretionary and tech. I think that oil has been relatively tame given what's going on in the Middle East, but we think that it does continue to put pressure. We talk about higher for longer with interest rates. We think higher for longer with oil prices as well.
Megan, a lot of people are coming out of the market right now. They're doing what you're saying, and they're going into cash. You just look at the BlackRock numbers today in terms of the withdrawals that they're seeing. Clearly, a lot of people are thinking this. Getting back in, that's the thing that I'm beginning to think about. How are people thinking about getting back in? It's the question that I want to know. Everybody's saying to me, get into cash, but then what? What kind of triggers are you going to be looking for?
Yeah, that's a great question. It's one that some of our clients ask us as well. And basically, there's a couple things. First of all, stocks rarely, if ever, bottom before a recession. And given the fact that we think a recession is still likely, could possibly even start in the fourth quarter of this year, if you look at those consumer confidence numbers, that typically does tend to be a leading indicator for spending. So if it doesn't start in this quarter, at least the first half of next year. So we think the volatility in the equities is here to stay. We think that, as I mentioned, the PE multiples are way too high. We need to get some more realistic expectations there. That's what we're going to look at. When valuations and the fundamental picture all starts to come together, that's where we'll start to put money to work.
Megan, are banks on your list? I mean, in some ways, they're perfectly set, in some ways, to manage volatility, say, through the investment banking and trading divisions. But then the other side, they're dealing with the consumer issue. I mean, we saw reserve releases for J.P. Morgan, but then, of course, Jamie Dimon worrying about dangerous times ahead.
Yeah, I mean, the financials are a very interesting area to look in, but it's a very broad area too. Right now, we're not, looking at the financials to add money into them at this point. I'm more concerned, as you mentioned, the consumer, not only the consumer, but businesses. Take a look at the small business, the loan rates on that. These are very high. This is going to start filtering into the small businesses. The consumer, as we mentioned, auto loans. You heard from some of the big banks today that they're seeing a big uptick in the auto loan delinquencies. We haven't even talked about the small and mid-cap banks yet. Now, I know that their PE multiples are attractive if you look at them, but whatever happened to the first quarter of this year when we saw the biggest problem they had was the rise in Treasury yields and what it did to their balance sheets? No one's talking about that, and yet we're even higher than we were then from an interest rate perspective. So I think that there still is a lot of trouble that could be brewing in the banking sector. We're just not comfortable there yet.
Yeah. All right, Megan, thanks a lot. We really appreciate it. Megan Horman, Verdant's Capital Advisors, CIO. Thank you very much. All right, it is 16 past 7 on the West Coast. We want to get you to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its gorgeous morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. And Ed, we are inching towards a historic moment in space. A NASA probe sitting on top of a SpaceX Falcon Heavy rocket is set for an unprecedented journey into space. I think it's going to last about 8 years. What are we looking at? What are we expecting?
Yeah, I mean, what you're looking at literally is the nose cone carrying the payload atop that Falcon Heavy. And whether you're a space nerd or you are a human being, it's an important mission. That payload over a 6-year period is heading toward an asteroid called Psyche, which is currently orbiting somewhere between Jupiter and Mars. And the hypothesis is that asteroid is the remnants of the core of a planet. And so the question that NASA is trying to first pose is that the case? But the bigger picture is, by using what's in that nose cone, the payload, a sort of trio of very high-tech sensors and instruments, can we learn something about our own core here on planet Earth and the future of this planet based on the sort of elemental composition of that asteroid.
Ed, talk to me about SpaceX and NASA coming together and the significance of this mission on that front.
Yeah, I mean, mechanically, this is the first time that NASA will do any sort of deep space exploratory mission using Falcon Heavy. The mechanics of the relationship has so far largely been Falcon 9, and as we've done many times on this program, and I've enjoyed every one of them, it's been a relationship where SpaceX ferries astronauts to and from the International Space Station in the Dragon capsule or resupplies, and those contracts between NASA and SpaceX run into the billions. This is a payload that is non-human. They are scientific instruments and pieces of technology to gather data, but it's a next step forward, and it's a $1 billion project, so this is big.
We're counting down here. We're just about a minute away from launch. Ed, how much is SpaceX making from this?
This is the thing. You know, you think about a per launch, the numbers vary from the sort of high tens of millions and above. The key point of the economics is the cadence of launch and the supply chain that SpaceX has established to make a reusable rocket. In the first instance, break even, and they make cash.
Is it startup? Now we're going to get the go.
So we're about to just walk me through the next few minutes, Ed. We're 45 seconds away from launch.
Yep, so as you see, you have the main booster, and it's shrouded by the vapor, a byproduct of kind of the systems in preparation of launch. But those two side boosters and main booster will be taking this beyond Earth's atmosphere. It's about an 8.5-minute process to kind of get into orbit before anything really happens. But, you know, the key moments to kind of look out for are max Q, maximum pressure or aerodynamic stress on the rocket after about a minute, and then we'll see it all happen pretty quick.
T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, engine ignition. And liftoff. Liftoff of Falcon Heavy and Psyche on a mission to a metal asteroid in deep space to study the building blocks of our planet's inner space.
Vehicles pitching downrange. M1D chamber pressure is nominal.
View there from the onboard camera on the booster. Beautiful shot there as it goes through the clouds.
Power and telemetry nominal.
Through here, Joe, the power telemetry are nominal. We're also looking at the data for all 27 engines. And
Falcon is supersonic.
All chamber pressures look good, and Falcon is supersonic now.
Throttling down in preparation for max Q. A moment of peak mechanical stress on the rocket.
What will happen here
max
is
Q.
The side boosters will be at full power, and the center core will be at a reduced power to go through max Q to reduce the pressures on the structure of the launch vehicle.
Coming up in 30 seconds. We'll start getting ready to have those boosters cut off.
Vehicle's looking good, pitching downrange. All telemetry looks really good so far, Daryl. As we see a beautiful view of the Falcon Heavy and center core and side boosters there. Data is looking really good.
All 27 engines of the Falcon Heavy putting down 5.1 million pounds of thrust. Standing by now for booster engine cutoff for those side boosters. The center core booster will continue on.
Booster engine cutoff. Side booster separation confirmed.
Great shot there of the side boosters coming off the rocket.
MVAC engine chill has started.
And there we start the chill on stage 2 as we get ready for MECO on the center core. Stage 2 will continue chilling down, making sure the fuel and propellants are flowing through that MVAC, getting ready for ignition.
Those boosters will have three burns.
At its absolute top speed, Falcon Heavy traveling at like 24,000 miles per hour. What you saw was those side boosters separate from the main booster. They are now going to fall back down to Earth. They're going to do what's called a boost back burn, kind of orient themselves correctly, go back down towards Earth, and they will attempt to land both of those side boosters, guys. But my understanding is they won't try and recover the main booster, you know, which they normally do with Falcon 9.
And Ed, this is going to be a long process, right? Because now it goes 6 years, right? It's going to take 6 years to get to the asteroid and then 2 years to circle it, right?
Well, here on Bloomberg Markets, and you know the European closes up next, we do expect some things to happen in the next hour, but yeah, after that it's around a 6-year journey. The first stop is Mars, and it's really interesting actually, because what happens is the propulsion, they use the gravity field of Mars to kind of slingshot themselves towards the next stage of the journey, which is this asteroid belt, as I said, between Mars and Jupiter. And then after that, it's basically a solar-powered electric propulsion system to get it the rest of the way. The thrusters are powered by solar, which is pretty neat, right? Like, you're getting close to the sun. What you just saw, by the way, was first and second stage separation, which also is pretty neat.
What a beautiful shot
Ed,
there.
This looks like it's going like clockwork. I obviously don't want to jinx it. It is Friday the 13th, which I thought was a brave call on their part to launch on a day like today. But what's happening behind the scenes here? Are we seeing an acceleration of the scientific community now that they have usable, reusable, relatively cheap and kind of scalable technology to get technology into space? What's happening behind the scenes in terms of the scientific endeavors being pursued?
So it's this is the fantastic question. I think we probably focus on SpaceX, right, in the context of it being the world's most valuable startup. You know, my colleagues and I reported recently that based on a secondary, they were doing the valuations like $150 billion, money, etc. But the story that you're speaking to is critically important, that they've basically lowered the threshold for entry. So if you're a little satellite maker here in Silicon Valley in Europe, you can catch a ride now. You can put your little payload into orbit at a cost that's realistic. And what we're talking about is public sector money, right? And that has a limit to it. So I think that's the right question, Guy. And in this case, though, reminder that this mission's about $1 billion for NASA, but NASA's got the budget.
Hey, so what is the payload?
On the right-hand side.
I love this question. Let's get super niche, super deep. There's basically a triumvirate of sensors that want to gather particular data from the asteroid psyche. The first is a gamma-ray neutro spectrometer, and basically what that does is measure the elemental composition of the asteroid. It is a metal asteroid, but remember the hypothesis is that it's a remnant of a core, a planet core. The next one's a magnetometer. That basically measures the magnetic field that's left around Psyche, and that's important because if there is some sort of remnant of magnetic field, it does indicate to us that was once a core, and then you can use a radio and cameras to kind of map out the rest of that gravity field and the sort of shape and composition of the core. And all of that data is actually going to test another system called Deep Space Optical Communications, the DSOC system. Because as I said, this asteroid is between Mars and Jupiter. That's very far away. How are they going to get the data back to Earth? The answer is basically high bandwidth optical communications. You know, sending stuff all the way back using a new level of near-infrared lasers. So basically, layman's terms, a lot of tech on board.
Thank you for that.
That's the simple
fair,
answer.
Right?
We'll take that. We'll take that one. And then what does that teach us about us? What does that teach us about our planet?
This is where not my enthusiasm or my wanting to know, but basically my knowledge runs out. I think that the idea is that if you're a geologist and an Earth scientist and you just see the side booster, one of them at least, re-enter Earth's atmosphere, and as we said, they'll try and land both of the side boosters back on Earth. You know, basically, I think that we look at the life cycle of planets and stars, and we try and work out what on earth is going to happen to planet Earth over like a very, very long time period. Don't worry about our lifetime, guys. Don't see this as a stressful sort of.
Yeah.
I don't even want to use the word. You know what I'm trying to say.
Yeah. We've got sort of issues that we need to deal with right now. Yeah, I appreciate the fact that this may be further out.
Hey, Ed. I also like the fact that you distinguish between space nerds and humans. So if Guy and I are humans, you tread the water here. What are we watching right now on the left-hand side?
You're watching, I think, them cycling through shots of both side boosters, landing on Earth, designated launch pads. There's one of them. It looks nominal. Nominal meaning as in everything went fine. The second one touching down. Everything looks nominal. That looks fine. Where are we? We're 8 minutes and 25 seconds into the mission. In about 56 minutes' time, the Psyche payload will deploy and send on its 6-year journey. So there you go.
Amazing stuff.
It's amazing. It looks like CGI when these things are coming in.
It does, doesn't it?
It is absolutely incredible to see this stuff actually happening and the reality of it. You can land 2 boosters. This is proper sci-fi stuff. Absolutely incredible. Ed, just talk me through kind of what the next mission is. What are these 2 side boosters going to be used for next? What is SpaceX's next big step forward?
Oh, I honestly don't know the answer. I don't think that there is a Falcon Heavy mission scheduled. This is only the 8th time that the Falcon Heavy system has ever launched. Remember, it's not the future. The future is Starship. And I think we're all waiting to see SpaceX put that next-gen Starship to the test again, because they got it off the launch pad last time earlier in the year, you remember, but it exploded.
Ed, thanks a lot. We really appreciate it. I feel like these launches now for all of us are becoming more rote, which is kind of incredible and amazing. Thank you for taking us through everything there. Bloomberg's Ed Ludlow. And definitely catch Ed and Caroline Hyde on Bloomberg Tech. That's coming up in about 90 minutes time. And we're about an hour into U.S. trading session. Equities now a little mixed. NASDAQ 100 flipping into negative territory. Bond still getting a bid after that disappointing UMISH report at the top of the hour. Abigail's tracking those moves. Abby?
Yeah, relatively small mixed moves here on this Friday, Alex. On the week, though, we are looking at gains for the S&P 500, a second up week in a row. The NASDAQ, we're looking at a third up week in a row. Weakness, though, for the Russell 2000, and this index has, in fact, put in what is called a death cross today, which signals technically that there could be some more selling pressure ahead. As for those yields that Alex was just talking about, if we take a look at what's happening over the last month, it's a real roller coaster ride for both the 2-year yield and the 10-year yield. You can see the 2-year yield, back above 5%, the 10-year yield at one point, the 10-year yield above the level of the last rate decision. It looks like technically it may hold 440. If that's the case, it could put pressure on the stocks. Although Mandy Zhu of SIBO yesterday made the point that rising rates here could be on the expectation of some sort of normalization, soft landing, and that may not pressure stocks in the same way. As for what's beneath the surface for the S&P 500, that relatively benign loss on the day, JP Morgan, a barometer of the banks here, up 2.7%. They, of course, put up a surprise beat for fixed income. Equities a little bit weak, but their loan loss provisions, their net interest income fiscal year guide better than expected. And then loans up 17% in the third quarter, better than expected. Progressive, a strong quarter. Analysts positive on the fact that they are likely to keep $9 per profit and on the quarter. And then we can see some laggards here, Alex.
Yep. Netflix ain't coming out next week with numbers, so is Tesla. All right, Abby, thanks a lot. Really appreciate it. Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. Let's get more into the U.S. bank earnings. Joining us now, Bloomberg's Shonali Basak. Were you surprised at how strong across the board these guys were?
Listen, a lot of these banks have sold off pretty meaningfully this year. And if you took a look of the big 6, you only had JP Morgan really up on the year. But JP Morgan, when they're raising their guidance for net interest income, the fact that they're doing it for the 4th time this year, of course they're going to get some love. Wells Fargo and JP Morgan also coming in very meaningfully in terms of credit losses, in terms of write-downs. Altogether, the big 3 banks, JP Morgan, Wells Fargo, Citigroup, took in more than $1 billion less of credit write-downs than you would expected. So things were meaningfully better in terms of loans going bad. across those three banks. So you are seeing the lift, but take a look at the KBW Bank Index today. It's pretty remarkable, the divergence between the biggest banks and the rest of the industry. PNC also reported is down almost 2% on the day. And so that divergence between big and regional is certainly continuing on the heels of these results. And that choppiness is to be expected through the rest of the season.
Shai, this is going to sound like a weird question, but it actually makes sense in the light of what you just said. Are the big banks a good guide to what is happening with the U.S. economy?
Listen, one number that we love to look at, I know we talk about this every time and more so, is when Bank of America reports on Tuesday, I always look at that FICO score trending up. In addition to what the loan books look like, where are they lending? When you look at Wells Fargo's loan book, even though they're increasing their net interest income, the more economically sensitive parts of the economy, home loans, auto, are still under pressure. They're just not feeling the same pains as they were before because they've done a lot of cleanup in those books. And so when you think about the region, you're right, they are much more exposed to those economically sensitive parts of the economy that are very much clearly feeling more pain than the clients that you're seeing at these big banks. And something interesting here too, if you're thinking about Wall Street businesses, JP Morgan, look at its private bank and the revenue just really surging in the most recent quarter. The higher net worth individuals are clearly creating benefit here to the biggest banks, which again will fare well for Morgan Stanley as well on Wednesday if they can keep up with this pace.
No, that's a good point. What did you make of Jamie Dimon saying that it's the most dangerous time the world has seen in decades? Like, what was the context for that? And did he address that more on the call?
So the context here, and he addressed it very much in the statement, he gave a bunch of factors, including still the ongoing war in Ukraine, the Israel-Hamas war, the food and energy concerns, the pricing around them around the world, and separately, not related to the danger, but he's talked about the market concerns there are about quantitative tightening and what that could mean. And so, yes, a lot of concerns, clearly. In the near term, honestly, because of the volatility of the markets, stocks, bonds, currencies, commodities, particularly rates and commodities, Citigroup had the best third quarter in a decade on the heels of these moves in markets. So unless that turns to stifling, these banks are still getting a benefit from those trading businesses that could also be continuing to see big investment banks next week.
And this is really interesting because in some ways, Citi's about Jane Fraser right now. Citi's about the turnaround story. Citi's about this long-term project that she's putting into place. These numbers, in some ways, aren't a reflection of that, are they?
The future is very important. And even Jamie Dimon and JP Morgan are telling you that things may not be at this level forever. Things will normalize, both in terms of the revenue side as well as the cost tied to credit. Jane Fraser's turnaround story here is quite remarkable. This is a pretty pivotal quarter to show numbers like this as she started this next phase of the restructuring, if you will, because not only have they changed management at those very key businesses, trading, investment banking, you're also watching Citi here now saying they're going to remove 5 layers of management. 5 layers. And so that will come with costs. That will come with severance costs. And that has to be accounted for in the upcoming quarters.
Great stuff, Shonali. Busy day for Shonali Basak. Thank you very much indeed. Busy week next week as well, as she's alluded to. Shonali's going to be back a little bit later. We'll update you on the calls. We'll make sure you're up to speed with what is being said. I want to update you on another piece of news right now. Sean Fain, I think he started a little bit late, but the gist of the statement that he's been giving us this Friday is that talks are progressing. As a result, it doesn't look like we're going to see extra strikes coming from the UAW that are going to impact the big 3 automakers. It does seem as if maybe some progress is being made. It was interesting to hear Ford talking a little earlier on about the fact that basically they've given all they can give. They can tweak things, they can change things within the package, but they're kind of as far as they can. They've gone as far as they can go. So we'll see whether or not next week we see some of that progress resulting in some of these strikes being rolled back. But we'll wait and we'll watch. But that's the latest from Sean Fain and the UAW. I want to get back to the bank story and talk about what is happening here. So far, so good, seems to be the narrative. Bill Smead, founder and chairman and chief investment officer at Smead Capital Management, joins us now. They hold JP Morgan, they hold Bank of America, they've got American Express in the portfolio as well. He joins us now from Seattle. Bill, these numbers look strong. As an investor, are you happy with what you're seeing here?
Well, of course we are. We've owned JP Morgan and Bank of America since 2012. So the way we look at them right now is they're doing a really good job of running their business, and the things they don't control have a lot to do with how cheap the stocks are in relation to the rest of the stock market. So that's a self-healing thing. And then secondarily, you have to kind of understand where we are from a historical perspective. I think you just had the segment about the rockets going into outer space, right? So what time period did we have rockets going into outer space? Very high fiscal deficits that got monetized in the Vietnam War and Johnson's Great Society, and Arab oil embargoes and inflation that seemed harder to control than what you wanted. So the answer is welcome to the late 1960s. Warren Buffett got so frustrated with those circumstances he closed his partnership. So it's quite a good lead. And so the banks are trying to deal with the fact that you kind of know there's got to be some kind of a comeuppance in the stock market over the next 3 or 4 years.
So Bill,
yeah.
Does that mean that the banks for you are playing defense, or you've just owned them for so long you're just going to hang tight?
No, they're very inexpensive relative to everything else we could own, and that makes them very attractive. Nothing I like more than sitting here at 4 times plus dividends what I paid for something, and it's been cheapened up by the circumstances that they don't control. If they've shot themselves in the foot, we have a problem. But this is just the normal ups and downs of markets and the normal ups and downs of the economy.
Okay, would you buy more of them?
If I didn't own them, I'd be buying them.
Would you add to position? Would you add a position though now?
I can't tell you things like that.
Why not?
Because I can only tell you that after the end of each quarter.
Fine. Okay. We'll check back at the end. Fine.
So in terms of if you're looking at the economy, describe to me, you just kind of walk me through what you think is the relationship between what is going on in the economy right now, what's going on with fiscal deficits, what's happening with the government, rockets going into space. This is the 1960s. Is that the message that the banks are delivering? Because these are really strong numbers, and I'm wondering, and I asked this question to Shalani just a moment ago, are big banks a good guide as to what America's economy really looks like?
Well, their stocks are a good guide to what the average stock is doing, right? If you take out the Magnificent Seven, stocks have made no money this year, right? The vast majority of S&P 500 stocks are down for the year. So to go back to your question, the economy's strong because when you pump $10 trillion of monetized fiscal deficits into the system, when you hand out tax credits for environmental clean energy investments like candy, and then you have 92 million millennials who were late to get started on household formation, waking up 2 or 3 years ago and starting to get married, have kids, buy houses. There's an underlying positive current to this economy that has nothing to do with policymakers. And therefore, the frustration is we think that Chairman Powell and the Fed are a brain surgeon, but inflation is a cancer. So we have a brain doctor working on a topic that needs a cancer doctor. And therefore, they're unlikely to solve the inflation problem, just as unlikely as it was in the 1970s when those Fed chairs were trying to do it.
So, okay, that definitely feels like higher rates for longer in a big, big way. Can I just ask you about oil for a sec? Because we are seeing oil rally. That's a geopolitical issue. But we also had that major oil merger this week, Exxon Pioneer. And the talk on the ground is that we're going to see a lot of buyouts now, a lot of targets that are private, but also public, like a Devon or an EOG is sort of on the table. Are you playing that trend at all, Bill?
Well, we have about 25% of our portfolio in oil and gas. And we own Ovintiv, Apache, and Devon. And we wrote a piece 3 months ago basically saying we expect people are going to drill for oil on the New York Stock Exchange. And that's what it is. Exxon just drilled for oil And if you buy a company with existing wells and existing production and expand the life of your business by buying another company, you're not going to get the condemnation from the environmental people on poking holes in a new place. So it's just, there is going to be mass consolidation in this industry, and there's a huge gap between the price to free cash flow and the price to earnings of the, you know, everybody below 40 billion in market cap versus the Chevrons and Exxons that the big money had to crawl into because of lack of liquidity.
Well, if you look out of the window of the building you're in right now, you're going to see Amazon, you're going to see a range of technology companies. I'm wondering what you think of them right now in a world that you're describing that kind of points us in the direction of much higher yields from here. Do those big technology companies look like good investments to you right now?
Well, first of all, what I see looking from the window I'm at in Seattle is a bunch of partially, mostly empty office buildings. A place where just thousands and thousands of people, including myself for 40 years, came to work. I'm in a building that I worked in the mid-1980s when it opened brand new. And so the fact of the matter is, one of the reasons the regional banks are performing poorly relative to the big banks is because the regional banks are much more exposed to commercial real estate of the office building type, as opposed to Bank of America and JP Morgan. So the answer is, I see that. That was created by a boom that came from Amazon parking 50,000 people in downtown Seattle. And I just walked by a building that Amazon built that is now being turned into residences because there's no one in it at Rainier Square.
So it felt like that was a knock on corporate real estate and also maybe a little bit on tech. Bill, listen, we really appreciate it. We got to go, but thank you for joining us. Tell Cole we say hi. Bill Smead of Smead Capital Management. And speaking of banks, we will be hearing with Wells Fargo Bank CFO on Bloomberg Television. That's coming up at 2 p.m. New York time. We have some breaking news for you. Sean Fain, the UAW president, is speaking now at a Facebook Live event. In the latest update on the auto workers' strike, car makers have been spared from new strikes. This is as talks progress. You can watch more in real time at LiveGo.
Companies and the corporate media tried to scare everyone about the devastation our strike would cause. They tried to convince everyone that it's dangerous for the working class to fight for more. Instead, they're learning a hard fact. The working class in this country is fed up with being bullied by rich corporations and the wealthy. The working class in this country is sticking together. The longer our strike goes on, the more the public stands with us. The longer our strike goes on, the more the public turns against corporate greed at the big three.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero!
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
The broadest S&P 500 tracking ETFs are seeing above average inflows. Want to find out what's kind of driving this trend in today's ETF Friday. Bloomberg's Emily Grafeo is here with the details. All right, Emily, what's driving it?
So the underperformance of active this year seems to be driving extra flows into S&P 500 ETFs and more broadly passive strategies. There's only 4 ETFs that track the S&P 500, and those 4 ETFs have taken in 27% of all equity inflows this year. And not only is that a big change from last year when they took in about 10%, it's also the highest proportion since 2016. So it seems like investors here are looking at the performance of big tech, which is really a large part of the S&P 500, and just allocating to that passive strategy as opposed to some of the active here.
In theory, Emily, single stock correlations are really low right now. You're getting some really big movements within the market. This should be a great time for active. But that's not the message you're giving me, it sounds like.
No, I mean, if you look at active ETFs, and there's not a lot of active ETFs. The active management ETFs only started a few years ago, but only 28% of them are beating the S&P 500. And it's not just active funds that are core equity, but if you look across ESG, thematic, factor-based funds that Bloomberg Intelligence tracks, most of them, a majority, are actually underperforming the S&P 500. And this is a sea change from last year when we saw factor ETFs, 70% of them were beating the S&P 500, now only 15%. So think value, growth, tilted funds, those are all underperforming.
Guy, I have to wonder if this goes to your whole theory that the narratives change so quickly, so you just can't, and I appreciate that that's where active should be good, but when the narrative literally whipsaws daily, it feels that creates problems for this.
Yeah, in theory, this should be a great environment, but you need some momentum within some of these trends. And that's been where the real challenge has been. Yes, you're getting low correlations, and yes, you're getting things bouncing around all over the place, but there's nothing seems to last for long. So even if you get it right, you're going to get it wrong pretty quickly.
Right, hence the factor investing in last year, a different story. So, Emily, I'm also wondering, end of year balance, rebalancing, and all that stuff. I feel like we usually talk about it after November, but I'm wondering if this is a little bit different because we've seen so many big moves. Are you seeing some of that? Like, do you think that's part of it?
Yeah, you might expect to see, maybe because of the fact that passive has done so well, now some funds think big model portfolios shifting out of that passive allocation, but we'll really have to see. We have a lot of index rebalances coming up into the end of the quarter. And actually, if we're talking about indexes, FTSE Russell is now considering doing a second annual rebalance, so changing it from annual to semi-annual. We just had that announcement a few days ago. So that might even bring in more volatility, more movement when it comes to these big funds shifting from active to passive.
It's amazing, isn't it? In some ways, this would be such a great environment. Emily, thank you very much indeed. Emily Grafeo joining us at ETF Friday. Alex, you want a great example of this? Look at LVMH versus Novo Nordisk.
Yes.
I think the gap now, LVMH used to be the richest company in Europe. It's now Novo Nordisk, and the gap, I think, is now 100 billion. The speed at which this has all happened, absolutely eye-watering.
Yep, and sort of how do you play that trade now, right? Like we got sort of a sales and rev outlook for Novo Nordisk. It was released accidentally earlier today, but it was super solid, right?
Yep.
It drags up its peers, but at this point, how do you not own it, but then how do you buy it at this point? So I don't know how you manage that.
Absolutely, and it's the same story as big tech as well in the United States.
Sure.
But you look at how fast the luxury sector has fallen in Europe. It's been eye-watering. The value destruction there has been seismic as the Chinese, then the American, then the European consumer starts to roll over in a big way. Absolutely amazing to see this all happening. Anyway, we'll talk about Novo Nordisk in the next hour. Much more to come in the European close on that story. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So a little more movement at the index level on the equities today. There you go. We're down by 0.8%. We're still not far away from the middle of the range that we've been in since the beginning of the year, but we'll take a little bit of movement. Single stock sectors, that's where the action continues to be, this kind of violent rotation that we continue to see really present again today. Two sectors in positive territory today. The main one is energy. We're up by 1.29%. You're seeing all the major names. I think Shell hitting a 52-week high again today. The other story that, of course, we've just been discussing is Novo Nordisk. That stock up by nearly, well, I don't have a percentage for you, but we're up. Let me assure you of that. And the reason for this, a little release that we didn't expect earlier on in terms of the numbers that they are going to put out. And unsurprisingly, given what is happening here, they are upgrading their figures. Ozempic, obviously, where all this stuff is reverberating and demand is massive, and as a result of which, unsurprisingly, the numbers get better and better. It feels like it feels like the AI story right now. Anyway, Maria Waitman is going to be joining us from State Street in just a few minutes. We'll talk about this market with her. This is Bloomberg.
me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and
just so many, business combinations that are possible, and but I don't have an informed view of that sitting here today.
Phil Spencer, what task does he have to take all of the people working at Activision and bring them into Microsoft? Do you think that there's anything he can learn from your company?
Look, we have a fantastic company with an extraordinarily talented workforce. People are passionate, motivated, enthusiastic, excited about this merger. And Phil is an extraordinary leader. I couldn't think of a better person to give the reins to for the business. He is a passionate gamer. He's been involved in this industry since 1989. He's incredibly technically capable, visionary leader. People love working with him, and I think it was actually one of the really appealing parts of this transaction was to know that the people that I've worked with for 3 decades are going to have a leader who is extraordinarily capable and passionate and compassionate and will do a wonderful job leading the combined companies.
We're speaking with Bobby Kotick, the Activision Blizzard CEO, here on Bloomberg Television and Bloomberg Radio. And Bobby, as we discussed, you will stay until the end of the year and then focus, it sounds like, on philanthropy. But to those that don't know you as well, the video games industry and market is huge, but there will be people that don't know your backstory. It started in software, right? It started, there's a tie to the early days of Apple. You've been able to work with Microsoft now, and the story of the year is generative AI. And I wondered if you could just give us some illustrative examples of how you think their work in AI is going to read through to video game development, no matter how niche, NPCs, customization.
Look, AI is going to, and in fact, when you think about the talent that it will be required to move the art form forward and to be able to create new innovation, AI and machine learning are going to be the important new technologies that are going to be transformative for the future types of games that we'll create. There are so many important applications, whether it's generating art or an animation or onboarding players or creating greater experiences for players through better tools like player matching. There is an enormous amount of benefit that will come from the evolution of AI. It's the early innings, though, of really figuring out how to translate what is the available technology today into practical solutions for gaming. But I think this is one of the big areas of opportunity for us on a combined basis, because Microsoft is, clearly right now, I think, the leader in AI and machine learning. So, Ed, I wanted to say thank you very much for the opportunity to have me today. I really, really appreciate it. And I look forward to continuing the conversation. And it was very, very generous of you to include me.
All right, Bobby Kotick, Activision CEO for now. Thank you.
Thank you very much.
This is Bloomberg Technology. Thank you.
That's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield. Because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
All these traveling experiences that we've been doing, we're going to pull them together and start to build out these more permanent experiences. This is a concept of something we're calling Netflix House.
We're one of the largest sports platforms out there if you think about YouTube. Everything from our YouTube creators that are focused on sports to the consumption of highlights from all of these leagues.
You know, we had the most amazing experience at the E! Network with NBC, Comcast, and that whole group for many, many years. And then I think it was just time to have a new chapter. And I really felt like streaming was in the cards for us.
I want to make sure that when people come to my Instagram or whatever, that they know that they're not being tried to be sold something all the time.
I do want to touch on the sale of ABC stations. Have you already submitted a bid, or you're looking to submit a bid?
When I submitted a bid, I texted it to Bob.
Okay. Okay.
Okay, let's go back to some of the Bloomberg screen highlights, some of which we're just watching. Starting with YouTube CEO Neil Moen speaking about his priorities when it comes to live sports competitions, following YouTube TV, of course, winning the right to broadcast the NFL Sunday Ticket games back in December. He sat down with Bloomberg's Lucas Shaw to talk about what's going on.
It's very early on. We're a few weeks into the season, but I feel really, really good. I feel that the first and foremost, my priorities literally from the day that we signed the deal was on the user experience, our fan experience on YouTube, joint fans of the NFL and YouTube. We have millions and millions of sports fans on the platform, and the whole point of Sunday Ticket was to super serve those fans. And so everything from, what gets all the headlines, which is multi-view and, kind of 4 games at once and what have you, to latency, to the clarity of the picture, and then all the features and things like that that we have, that users of YouTube TV have known and loved on Sunday Ticket. So really, really focusing on that. And that has gone, knock wood, really, really well from all the feedback that we've seen. So I feel great about the product that we put out there.
You like the multi-view?
I use the multi-view every week myself. I like the multi-view, especially the one with Red Zone in one of the windows for me. And that's like, as a huge sports fan, like that is like kind of like the perfect Nirvana experience for me.
You talked about being a platform for sports and having different rights. As I unfairly mentioned at the top, you're a big NBA fan. Those rights are coming up. Are you interested?
So what I will say is we're taking it one step at a time. Right now, the NFL Sunday Ticket is a big area of focus for us. And again, as I said, getting that viewer experience right, making that game day experience on Sunday flawless and seamless. And you should expect from us a lot more innovation there in terms of products, in terms of creator integrations, all the things that our fans, especially younger fans of the NFL on YouTube, expect. You should see more of that through the season and in the many seasons to come. So that's the focus. Regarding the NBA, they have been longtime partners. They operate one of the largest channels on our platform. My 15-year-old is a huge sports fan just like me. He watches a lot of NBA highlights, and he watches them on YouTube through the lens and the analysis of a lot of his favorite creators. And so we have a long partnership with them, but in terms of our focus right now, it's about this NFL experience.
That was YouTube CEO Neil Moen at our Bloomberg Screen Time event in Hollywood, Los Angeles. You can catch more of that conversation online. Wrapping up our coverage from the inaugural Bloomberg Screen Time event in Hollywood, we sat down with the matriarch of the Kardashian family and discussed what led to their pivot to streaming.
I really felt like streaming was in the cards for us, and my family really wanted to try and tried to take a stab at that because that was really the future in our minds. We wanted to elevate what we were doing and streamline the show and have a new audience. Yeah. With it's Hulu and Disney Plus around the rest of the world, and the show's always been in so many countries and so many languages, and we have such an amazing following. And that transition for us, we were very lucky because we kept that audience and gained new audience, new friends, and we still have a wonderful relationship over at E! They're still airing some of our shows, and so it makes it nice because now it's a much broader audience.
You keep saying lucky, and it's interesting because it wasn't luck that first brought you to thinking about infomercials, about seeing what perhaps you hadn't seen at the time, which was a champion you were married to, that you had to lean on that relationship that Bruce at that time had with people who appreciated his sports, and then you led into infomercials, then suddenly it became linear television, then the transition to screening. How have you always been able to see basically where the consumer's going?
I think I do like to lean into opportunity, and I do like to think about what the next thing could look like. And in those days when it was about, okay, we have bills to pay, kids in school and things going on, and how is this going to happen? And I just had to really figure it out. And when I created Keeping Up with the Kardashians and brought it to Ryan Seacrest, and we brought it to E! And they said yes, and 30 days later we were filming. And I was just very persistent about the direction I knew I wanted to go in, and I think we were prepared for, but it takes a village. And I think when I say lucky, I feel lucky. I feel blessed to have opportunity that I can, extract this amazing career out of, and also share that with my family. And they have taken this and run with it. When you think about somebody in the entertainment business, usually they do it and they thrive and grow and perform on their own. And with me, we get to do it all together. Mm-hmm. It's not just one of us trying to do it all by ourselves and create this world for the whole family, but we all get to have a part in our present and our future and what we're going to do. So there's lots of family meetings, and we discuss what next steps are going to be. And the kids they've got amazing work ethic, and they never stop. So I feel like it takes a village. It takes all of us together, and I think that's the magic.
Kris Jenner there from our first ever Screen Time event in Los Angeles. Well, that does it for this edition of Bloomberg Technology. Don't forget, check out the podcast wherever you get your podcasts, Apple, Spotify, iHeart, and of course on all of the Bloomberg platforms. That wraps it up for what's frankly been one massive week in the world of technology. Caroline's off today. She'll be back next week. But from here in San Francisco, in Silicon Valley, wherever you are in the world, this is Bloomberg Technology.
moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, yields go for a ride. A sharp leg higher on Thursday cedes some ground to end the week. And Fed speak, it's mixed, with officials saying that the market is tightening rapidly. And inflation still running hot. But how hot is too hot for the Fed to push rates higher? We begin now with the big issue. The market gets ahead of the Fed.
The bond market is tightening financial conditions, and that is doing the work for the Fed.
The rise in the long end yields, if anything, was doing the Fed's job.
We think that the Fed is done hiking. I mean, we've been watching these rise in bond yields over the last few weeks and tighter financial conditions. And so we think that that is doing some of the work for the Fed.
The Fed is probably done raising interest rates because they realize that the bond market's been recently doing all the heavy lifting.
Don't worry. The Fed will have to do less because the market's going to do more. It doesn't quite work that easily.
Now we're coming off a week with drastic moves in the bond market. The 10-year alone, intraday, whipsawing over the last 3 days, 20 basis points or more. So what does that mean for the direction of travel here? Because we have seen kind of an orderly rise forward in yields, rise upward. But if you look in recent weeks, we've really tested those highs. In fact, have surpassed those highs fairly recently. Now the move lower in yields today supports the trend. But if we were to see a leg higher, then all of a sudden you have a new trend beginning. I want to lift up the board here just to show how painful this move higher has been for investors. Because people pouring money into the bond market, thinking that these yields were appropriate, have lost a lot of money. The last 3 years alone have been negative for bond investors, and this again is the 10-year alone. We are coming off the worst year since 1999 for investors last year. That trend is continuing now very meaningfully into the end of this year. Now joining us for more is Barry Knapp of Ironsides Macroeconomics and Brian Smedley of the Sinosure Group. Barry, you know, when we start to think about what we've seen just this week alone and what we've heard from Fed officials in terms of the idea that the market is doing the work for the Fed, do you believe them?
Well, I would frame it differently. We had
there's three ways to disinvert the curve, and make no mistake, the curve needs to be disinverted by 2024 for the banking system to absorb all the multifamily real estate projects that need to be rolled, the supply of credit to small businesses to flow in 2024. So of those three ways that we could disinvert the curve, we were on the benign path, which was a potential bull steepening where the Fed cuts rates because inflation is coming down, not because employment weakens. But what began at the beginning of August was the most insidious way for the curve to disinvert, which is a bear steepening, long rates rising, potentially through 5% on 10s and 30s, which would leave a lot of carnage in its wake. Bank portfolios, securities portfolios for one. And that move was well underway in August. We thought that the Fed understood the risks of exacerbating that move, but they made what I would consider their third communication blunder through the course of the tightening cycle. The first coming in September of 22, the second coming at the monetary policy report in early March of this year, which was quickly followed by bank collapses, and then again this time. So the Fed actually exacerbated this move. The market didn't do the Fed's work. The Fed exacerbated a supply-demand imbalance that existed in the Treasury because of unsustainable debt finances. And so I don't really think, I just would frame it as the Fed made a blunder here, which they tried to partially reverse this week.
Now, I want to point to another view in the market here, because former Federal Reserve Bank of St. Louis President James Bullard in Morocco on the sidelines of the annual meetings at the IMF and World Bank said the risk that's underpriced in markets is that disinflation stalls out or stops altogether and core PCE inflation starts to go up again. And if that starts to happen, the committee will have to contemplate going to 6% or 6.5%. What's that risk, Brian?
Yeah, I actually think that's an important risk for us to bear in mind. And I think I would differ a little bit in the interpretation of the bond yield move over the last few months. I think it's partly due to the fact that oil prices have come off weak levels mid-year. We've been choppy this week, up about $5 a barrel on WTI, but on balance, oil prices have moved higher. And in a world where the Fed needs to bring inflation back to target, any move upward in commodity prices that could pass through to inflation and inflation expectations needs to be met with higher real yields. And I think that's part of the story. Also, real GDP growth has surprised to the upside for the last couple of quarters. This talk that the markets are doing the Fed's work for it is reminiscent of what we heard in March when we had tightening in bank credit conditions or expectation in the turmoil of banks around Silicon Valley Bank failure. Well, if you look at real GDP growth in the 6 months that's passed, we've completed about 4% real GDP growth and very strong payroll growth in that period.
Now, if you look at this idea of the Treasury market as a haven bid, do you think that starts to complicate this idea that yields could go higher, Brian?
Well, I think so. And obviously, the situation in Israel, in the Middle East, is very tenuous. Let me just say that our deepest sympathies are with the people of Israel, of course, after this terrorist attack. And now millions of lives are disrupted with the war. But there is a significant risk of a disruption in oil supplies that could meaningfully impact the trajectory of the economy and monetary policy.
Now, it's interesting. You have Jim Bianco of Bianco Research Online also pointing out this idea that those sharp moves in the 30-year only happen when something's up. What is up, Barry? Do you think that these moves will continue to be exacerbated either because of macroeconomic reasons or because of Treasury market liquidity concerns?
Well, it's the supply-demand imbalance. I only really recall, and I've been at this 39 years now, two serious events where excess supply really caused a backup in long-term rates to absorb that supply. The first began on January 4th, 2021, when the Republicans lost the Senate. We went from expecting no new stimulus to an additional $1.9 trillion. If you take the 30-year real rate or TIPS yield, which is the part of the curve least impacted by the Fed's balance sheet or rate policy, that backed up some 60 basis points. The same magnitude of move occurred after the Treasury announcement that they were going to sell $500 billion more in the second half of this year than was expected. So to me, that was clearly driven by supply. And as I said, I think Fed policy exacerbated that imbalance. Now, the fact that they've backed away from another rate hike in November is a partial pivot that does provide some cushion. against instability in the back end of the market, but it really does come down to supply. And I actually spoke at an event with Jim recently, and I'm in broad agreement with him that things have changed a bit around the supply and demand dynamics for the Treasury market.
Speaking of supply, what about demand, Brian? When you look at what happened with the auction just yesterday, there was a lot of concerns about the dealers having to step up the way they did. How does that bode as more supply continues to hit the market?
Well, it's a challenge for the market to digest a great deal of bond supply, and Barry hit on the fact that those estimates from the Treasury have increased. And sometimes we could look at that and say, well, that's an exogenous shock to supply-demand dynamics in the bond market pushing up term premiums, but there's also an economic impact. The reason that bond supply from the Treasury is increasing to such a degree is because we have an enormous fiscal deficit. That fiscal deficit, the dissaving of the public sector, is being transferred into a positive balance of saving in the private sector and is furthering the excess demand story in the real economy. We've seen strong consumer spending, strong business outlooks, and so as we hear, quarterly earnings coming up, so far starting with JP Morgan, a pretty rosy outlook.
Speaking of JP Morgan, you had JP Morgan CEO Jamie Dimon bringing up the issue of quantitative tightening once again. He has repeatedly raised this risk. When you think about this, Barry, how much tighter can that create financial conditions in the wake of the balance sheet of the Fed stripping out some of that liquidity?
Well, there's a couple of issues that come to mind off of the things that Jamie said. First is quantitative tightening will eventually run into a problem in terms of total bank reserves. Now, those have been relatively stable around $3.1, $3.2 trillion or so. It's estimated by some, including my former colleague Joe Abate over at Barclays, that around $2.7 trillion in the bank liquidity is going to start to tighten, and the Fed may find themselves in a position of having to at least restructure QT, maybe take the reinvestment of mortgage paydowns and put them in Treasury bills to keep that abundant reserves environment in place. But the other thing Jamie got at, which is a much bigger issue for the banking system and for broader credit creation, is the excess capital that's being pushed by the administration and Vice Chair for Supervision, Barr. I would know, I did a lot of work at this back when I was Barclays equity strategist. In the 50s and in the 2010s, the 14 to 18 period in particular, bank ROE never got above 10%. In that environment, credit creation tends to be fairly tepid. That bleeds over into broader capital formation and overall aggregate growth. And so Jamie's not just talking about his share price. He's talking about aggregate economic activity from too much credit in the system. And lost in Michelle Bowman's speech earlier this week in Marrakesh was a pushback on that. So you actually have a little battle underway within the FOMC where Bowman doesn't want to increase those capital requirements and Barr does. So I think Jamie's really onto something because it'll make bank stocks really uninvestable if these proposals go through. They'll perform like they did through most of the 2000s when, as Barclays equity strategist, I was underweight them, but it'll also bleed over into growth and credit, the supply of credit. So
now, Brian, to the last thought here, the big question mark in the market is the yield curve. How are you reading some of these moves at the long end relative to the short end?
Yeah, I think the interesting move we've had in the last week has been a flattening of the curve, notwithstanding yesterday's week 30-year auction. Long bond has led the rally in yields this week, but over the course of the last several months, the story has been, a bear steepening in the yield curve, and I think Barry talked a little bit about the expectation that the Fed's not going to hike in November 1st. That potentially tees up an interesting decision in December. I think that will largely be dependent on how financial conditions evolve between November and mid-December. But I think what we'll be watching at Cynosure is whether, in a typical scenario where the Fed is on pause for an extended period of time, the 5/30s curve usually bull steepens, where there's a rally in the belly of the curve as the market prices in the next easing cycle, and the long end of the curve declines but lags the move. And I think it'll be interesting this time to see if we see a bear steepening where yields move higher, led by the long end, which has been the trend of late.
So market long in search for good news. Brian, thank you so much for your time. That is Brian Smedley of the Cynosure Group and Barry Knapp of Ironsides Research. Thank you very much for your time. Now up next, the auction block. A sweet deal arrives amid all the stress over rising yields. This is Real Yields on Bloomberg.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero!
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the auction block, where I want to touch on rates once again. I mentioned that high-profile 30-year auction, it was awarded at the highest yield since 2007. The primary dealer award was also the highest in more than a year. Looking at U.S. investment grades, J.M. Smucker tapped the market to help finance its acquisition of Hostess Brands. The week on the whole had over $13 billion in sales. And cruising over to high yield, a unit of Norwegian Cruise Line sold nearly $800 million to refinance debt. The home market priced about $2 billion this week. And on credit, PGIM's Greg Peters this week warning that borrowing is only going to get more expensive from here.
The cheaper credit has rolled off. That's going to be replaced with more expensive terms. And so if you think about how many companies, have really kind of utilized this zero and negative rate environment to their benefit, that really starts to go away. So I think credit, it really matters where you are in credit. And the more leveraged you are, the more susceptible you are.
And joining us now is Winnie Cesar of Credit Sites and Colleen Cunniff of Vanguard. Winnie, let's start with you here, because when we look at the caution that's seeping into the markets, things have held up pretty steady until now. At what point do bond investors get more materially worried about losses in riskier parts of the market?
So that's a great question, because we have seen credit spreads hang in much better than we would have anticipated. And we actually recommended that our clients take a little bit of a short-term cautious stance. We have that on really through the Fed meeting on November 1st. That also coincides with the Treasury refunding announcement, and will probably be when we start to hear more on the U.S. budget and potential government shutdown front as well. So I do think that in the near term, we could see some pressure on spreads as we have seen so much rates and now equity market volatility. And the reality of these higher borrowing costs are starting to become much more front and center as people look ahead to 2024.
Colleen, if you think about how markets have been behaving, the intense volatility in the safest markets in the world, when does that start to roll over and impact high yield and even investment grade markets?
Yeah, thanks for having me.
On the high yield side, obviously, and on the investment grade side, volatility is a concern. None of the markets like volatility, and the markets have held in pretty well so far. What we're continuing to look for as we kind of go out is signs of weakness that we think could flow through to the economics and fundamentals of the companies. As we've discussed in prior shows, we're heading into this environment with pretty strong balance sheets, but chatter about the consumer that has been very strong and driving performance, potentially starting to feel some weakness, could flow through into the numbers. So we're going to continue to look for that, and at that point, if you have that and the volatility combined, then you could see more impact on the markets.
Now, Colleen, what does this mean for new issuance? You are starting to see a market that is starting to come back. You are starting to see the core of Wall Street get excited about this idea of new issues. But do you think that some of this volatility can throw things off course and set off investor demand for new deals?
Well, look, on the high yield side, what we've seen so far in the last, say, month or so is deals coming to market. The market is receptive. Deals are getting done for companies that the market is well familiar with. Trading has been a kind of flat to sideways. So I think we're going to continue to kind of see that environment as we go through towards the end of the year. So markets are by no means closed, but I think people are selective. Like I said, everybody's just trying to find those points where we might start to see some weakness that could flow through.
Now, Winnie, if you think about the types of credit risk that are available in the market today, do you think that it is more prudent at this point to take on credit risk or duration risk?
So we have been more thoroughly embracing adding duration risk to portfolios. We've been recommending a barbell strategy for much of the year, telling investors that they should be starting to extend duration so long as long-on yields are above 4%. We're well above that at this point. Credit risk has outperformed quite magnificently this year and even last year as well, even though we did see some concerns around recession and defaults rising. And at this point, we do think that the duration play feels like a more attractive play on a long-term basis over the course of 2024.
Now, if you think, Winnie, about the entry point, at what point are you getting rewarded for taking on credit risk?
So I do actually like still a lot of the high yield market. I think that you have to navigate triple Cs pretty carefully, as valuations there are not particularly cheap, especially in the US market. Perhaps in the Euro markets, it's a little bit different. But double Bs, especially relative to triple B valuations, actually look pretty attractive on a duration-adjusted yield basis. And we note that a lot of double B capital structures are in very solid shape with fundamental metrics that are pretty much in line with or approaching investment grade levels. And then the single B universe, we have seen a number of issuers demonstrate that there's still investor appetite for new deals and the ability to refinance. And that leaves us pretty constructive on kind of the 3 to 5 year segment of those single B capital structures.
Now, Colleen, if you think about the point you made a little earlier, this idea that you have not yet seen a lot of pain, this idea here that the maturity walls are still coming up in high yield, bankruptcies are ticking higher, yet you're still not hitting levels that were reminding you of prior economic downturns. How much are investors really willing to take on risk, knowing that the worst of the bankruptcy cycle is perhaps not over and that these maturity rollovers will mean higher interest rates?
Yeah, I think I'm going to bifurcate my answer into the two markets that we focus on the leverage side, high yield versus leverage loans. The high yield market is just of better average quality than it has been through prior cycles. The default rates are continuing to remain pretty reasonable. And even when you look at the distressed rate and figure those turning into defaults, we still think it is pretty manageable. Even on the interest coverage, if you look through the metrics, over 4 times basically across the market is a much better position than, say, with the last crisis, right? So I think on the high yield side, again, we're a deep credit research shop, so we're always going to say you have to do your work and pick your spots and understand your companies. But I think we're pretty comfortable with the risks that we see on the high yield side. The leveraged loan market, that is a place where we think that more defaults will occur. And the credit fundamentals, particularly on the lower end of the leveraged loan market, meaning the smaller end of the leveraged loan market, continues to be a space where we think is relatively risky. Again, we pick our spots, but that's how we view those two markets at the moment.
That's Winnie Cesar of CreditSights and Colleen Cuniff of Vanguard. Thank you both for your time. Now, still ahead, the final spread, the week ahead. Earnings season plus ramping up, a host of Fed speak. This is Real Yields on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I'm Shonali Bassick, and this is Bloomberg Real Yields. It's time now for the final spread. The week ahead, coming up Monday, Philadelphia Fed President Patrick Harker is kicking off all of the Fed speak. We'll talk more about that in a second. Tuesday, Bank of America and Goldman Sachs reporting earnings, followed by U.S. retail sales. And on Wednesday, Morgan Stanley reports to round out the big banks before tech earnings begin. And then we have all of that Fed speak ahead of us, starting with Patrick Harker, Philadelphia Fed President. You also have Bostic, Logan, and Powell. Jerome Powell ending the week on Thursday, really the big moment of the week, speaking at the Economic Club of New York with our own David Weston. We'll also hear from many others throughout the week from New York to London, including New York Fed President John Williams speaking at Queen's College in London, and Fed Governor Christopher Waller also speaking in London. That would be the same day on Wednesday as the Fed releases its beige book on Wednesday, and that's on top of all the bank earnings and economic news that we will get for a very, very busy week for rates, coming off an already very volatile week for interest rates. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yields, and this is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
I'm John Oliphant. Welcome to Bloomberg Markets.
And I'm Matt Miller. We are, John, at session lows right now. Let's take a look for stocks at the equity indexes right now. The S&P 500 down 0.8%, off 34 points to 43.15, even though we've seen yields retreat a little bit. Look at the 10-year. Some buying going on there. We see the 10-year yield at 463.93. These two assets had been very highly correlated, although today investors are selling stocks and buying bonds. The Bloomberg U.S. Dollar Index up right now about 0.1% to almost 1275. So getting back, the U.S. Dollar Index is to its cycle highs, and NYMEX crude staging a little bit of a comeback as well, now up almost 5% to $86.97. This is, of course, West Texas Intermediate. What are you watching?
Well, Matt, where the investor base has decided to sell really has been technology stocks today. You talked about that higher price of oil. We have seen many of the energy names outperforming, best performing group within the S&P right now. Names like Exxon, which has gotten back pretty close to the levels it was at before we saw the big Pioneer deal announced this week. You've also got a standout name like Dollar General with a former CEO returning to the fold as the chief executive again. We've seen some of the gold names trading higher as well today. And then we're continuing, Matt, to obviously watch what's happening with the financials. I know broadly speaking, we're looking at some overall index weakness today for the S&P 500, but we are still looking at JP Morgan and Citigroup and Wells Fargo all in the green after they reported those quarterly results.
Yeah, definitely a lot of action in bank earnings. Beat wherever you look as far as Wall Street's biggest banks. Record profits in the third quarter. But a number of risks remain for the sector. Here's how Baird's David George feels about the industry.
The earnings so far that we've seen have been quite good. JP Morgan made over $13 billion in the last 3 months, and Wells and PNC also had very good numbers. The resiliency of these business models, and despite all the machinations of rates and credit and capital, the earnings stream and the revenue streams of these banks is actually quite annuity-like or utility-like in nature. So we feel pretty good.
All right, well, let's bring in David Conrad of the KWB team, covers the large bank equities for the firm. That idea of resiliency, David, would you agree with that?
Yeah, I think that's true, and thanks for having me on your show. We're certainly seeing that, I think, a more up market cap in terms of the universal model, a lot more diversification. And part of that benefit is we're just seeing a lot of trading revenue still flowing through. Citigroup their FIC was up 14% year over year off of a good quarter last year. So the diversified earnings are really starting to show. I'd also point out that on the deposit side, which is a big hot button with investors, still deteriorating. We're still seeing mix shifts weigh on earnings, but the second derivative, the rate of the deterioration is slowing, and that created a beat on net interest income for all four banks that reported today.
Are they having to pay more for their deposits, David? Because we know, they're charging a lot more for loans, and after SVB, it looked like there was going to be a big competition for deposits. Obviously, they're going to go to the big Wall Street banks, but are they having to ratchet up those interest rates?
Oh no, they definitely are. I guess my point is that is still a big headwind, but they did come in a little bit lower than what we were expecting. But they're definitely ramping up. They were up, probably 30 basis points from last quarter. And, I think that is going to weigh on them until probably the back half of next year. I think you're still going to see this deposit lag. We think there's a lot of CD maturities coming around in the first part of next year. And so that is going to weigh on the group. But my point is that it's getting slightly less onerous each quarter as we move through.
David, I was speaking to another analyst, Dick Beauvais, earlier today, and when it comes to some of the lingering uncertainties, since obviously earlier this year we saw what this interest rate environment did to Silicon Valley Bank, and I think a lot of people are still concerned about what's happening in the commercial real estate market, the idea that if these banks could have been setting aside more money for potentially bad loans, that maybe that would show improvements, and that if there is that worry out there, that can come back to bite some of the banks. How do you feel about some of their provisioning right now?
Yeah, I think that's why you're kind of seeing a bifurcation in the market today, where the larger GSIB banks are outperforming the regional banks, and the reason for that is twofold. It is the higher rates. So the AOCI marks, the mark to market of some of your bond portfolios, were worse than what we expected this quarter. And so that's going to weigh on capital as we move into earnings next week. And obviously that kind of makes you think back into March in terms of the mark to market on the capital issues. The second issue is what do higher rates do to asset quality? Interesting this quarter, the consumer fared very well. Credit card charge-offs were relatively stable. In fact, JP Morgan lowered their full year guide on charge-offs in terms of credit cards, but we are seeing non-performing assets increase on the commercial side, and we're probably seeing mid double-digit growth in non-performing. That's led by office, but I think some of the concern in the marketplace is it's widening beyond office and normalization and more standard commercial credits.
Is there any concern about the consumer, David? I mean, Jamie Dimon mentioned cash buffers are being burned through, and a lot of these banks did really well in credit cards, which means more consumers are putting purchases on cards and not paying off balances right away, rolling them over and paying the interest rates.
Yeah, it's one of those be careful you wish for, right? We're seeing 18% growth in credit cards. Now, one could argue we're still normalizing the balances that most people keep relative to pre-COVID, but you're right. I mean, we're seeing strong credit card growth, and we would expect as we enter next year, two major headwinds: the lack of excess savings that you pointed out in terms of the checking accounts, but also the student loan payments that'll be reinstated as well are some of the consumer headwinds that we're facing. But I think what the market reaction today is telling you is that they're more concerned with the CRE and commercial net charge-offs right now.
All right, David, great to get your thoughts. Thanks so much for joining us. David Conrad there, an analyst at KBW in charge of large cap U.S. bank equity research. Let's get to the geopolitical stories, because there are a lot of them making waves in the political and financial worlds. JP Morgan's Jamie Dimon had some alarming comments in today's third quarter press release For example, he said, "This may be the most dangerous time the world has seen in decades." Here's what ECB President Christine Lagarde had to say about political risks at the IMF event in Marrakesh this morning.
How we are seeing the situation now, and I put really the emphasis of now, after the three mega crises that we have gone through in the last 3 years, and the most recent developments that we haven't seen the end of, and which will have, in addition to the human toll and the horrible developments that will take place, that will have economic consequences. And it feels very much like, and I want to point to my notes because I listed them and I want to mention them for you, what I would call the multiple moving parts. And we're just not yet too sure where the chips will come down. And I would list in my moving parts the unwinding of large previous shocks. And Ngozi has alluded to some. There are multiple previous shocks, from the disruption to the supply bottlenecks, to the immense volatility of energy prices, to the pent-up demand against the restricted supply, and all of that happening in a very abrupt and sudden way. So that's number one. Number two, something which is affected by lag time, or time lag, whatever you call it. And I'm not here talking about monetary policy. I'm here talking about the adjustment of wages to inflation. And there is clearly, in everybody, in all central bankers' mind, the fear of the second round effect. Is it happening? Is it likely to happen? Are we at the peak, and are we now going to see declining wage increases returning to real wage a la pre-COVID? Question mark. That's another moving part. The third moving part is what I would call the strong. You know, we did 450 basis points hike in 15 months, which is a huge, unprecedented increase. And this is what I call the strong but lagged policies. We haven't seen the end of it yet. We're seeing tightening of financing conditions like it has never happened before. We know that there is some more in the pipeline, and how it is going to impact our economies, how it will have deflationary impact, disinflationary impact in our region is also to be seen.
Christine Lagarde there speaking on a panel out of Marrakesh with our own Tom Keene. Now, a new update from the UAW as Union President Shawn Fain says he will now call for additional strikes with little notice. It's not just a Friday morning event anymore. It's something you have to watch for every single day. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
And the markets are on the move.
The focus, of course,
focus is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Today, we're not announcing expansion of our strike, but we are prepared at any time to call on more locals to stand up and walk out. Moving forward, we will be calling out plants when we need to, where we need to, with little notice. So stay ready, not just Fridays and not just Ford.
Well, that was UAW President Shawn Fain speaking earlier today. This is Bloomberg Markets. I'm John Olkman with Matt Miller. Time for our Stock of the Hour segment, and we did want to check in on the automakers after the UAW spared GM, Ford, and Stellantis from additional strikes and talk progress. But Matt, as we heard there from the union head, they're going to shift away to a new strategy, perhaps try to create a little bit more uncertainty and potentially strike at random. We did see Ford yesterday say its offer for a 23% wage increase is the best it can offer. That is obviously not what the union is looking for, so I guess we see where things go from here.
Yeah, absolutely. And Ford said that, I think, out of frustration, right? Saying this is as much as we can do without injuring the case for more investment in the company going forward. The union seems to think that Ford could actually have done more. And yeah, there were no additional strikes today, but they struck on Wednesday one of Ford's most profitable plants in the world with like $25 billion of revenue out of Kentucky. Let's talk to new energy finance reporter Corey Cantor about this, as well as Bloomberg News reporter Gabriella Coppola. And Gabby, let's just start with you and what we learned today. It's not going to be like a Friday thing anymore on Facebook Live. They're just going to randomly strike when the UAW just randomly strike whenever they feel they're not making enough progress.
Yeah, I mean, I think that was the big takeaway from Fain's speech today, was that this is a shift in strategy. We already saw an escalation when they struck the Kentucky truck plant for Ford, because, you know, up until now they haven't really gone for the jugular, but going after that truck plant was definitely a heavy hit. And I think now, yeah, because Fain said he feels like the companies, once you get used to this rhythm of, okay, we have till Friday to give them something, they feel like their companies were slow walking the talks. That's how the union feels. So he decided to shake it up. And now, if they're not making progress, yeah, I'm very much on guard for more strikes.
What's the jugular? Is the Rouge, like if they strike the Rouge where they make the F-150, is that the jugular?
I mean, I think when you're hitting pickup truck plants, you know, especially for Ford, so much of their profit comes from the F-150, and they've already, you know, hit Kentucky truck. That's a serious blow. Yeah, you know, if you look at some of the other, like Stellantis, they've, you know, been striking the Wrangler plant since the beginning, but Jeep actually has a lot of Wranglers already in stock. So I think it's barely put a dent in their sales in that regard. But when you start hitting trucks, that's more serious.
Corey, you do a lot of research and analysis, in particular on the electric vehicle market, and obviously the longer this takes to get resolved, the bigger the questions are for trying to transition to a new business when you're going up against the likes of Tesla right now. Have you been able to ballpark if we're still not able to find common ground on pay increases? Is there a number that you're working off of that you think would ultimately resolve for both sides here?
It's not necessarily a pay increase that we focus on at BNEF. It's more that battery plant question. So if we flash back to last week, GM made a pretty big offer, according to the UAW, of putting those joint venture battery facilities under the national agreement. We haven't seen Ford and Stellantis match it at this point, but that's something that Bain and the UAW are definitely going to be looking forward from those other automakers moving forward. Not so much on the wage part, but the big three really do have to balance these negotiations with their EV investments moving forward. Tesla already has the advantage in terms of how much it's producing, and obviously is only scaling up quicker and quicker as time passes on. When it comes to Ford, Stellantis, and GM, they're really only doing a small portion, about 18% of electric vehicle sales in the first half of this year. They're falling behind, and it's not just Tesla. I mean, we've seen Mercedes, for example, increasing their EV share from last year. So it's getting more competitive, not less.
Corey, the concern for the union is that EVs require fewer workers to put together. Have you researched that? Have you looked into it? Because Mary Barra seems to think they're going to need the same amount of workers for EVs in the future that they need now for ICE engines. Like, is Tesla doing it with fewer people? Does it really require fewer workers on the assembly line?
We don't do labor research at BNEF. There was a report out from Heatmap News last week that covered this question, arguing that there'd actually be, in fact, some more labor for electric vehicles, at least in this decade. You really have to look at it as the automobile itself, but then adding on the battery manufacturing, as well as the kind of components that go into those batteries. So it's a complicated question, not one that you can kind of necessarily just say yes or no. The big picture, though, is whether you're talking about the kind of industry as it is today or where it's going tomorrow, the big three are falling behind. And so no matter how they kind of reach a negotiated settlement here, the important part is it's been a tough year on the EV front because they're going through that kind of manufacturing challenge. And so moving forward, they're going to have to increase their EV adoption. And while they're going through these kind of labor negotiations, EV sales on their end hasn't necessarily been hit at a high level yet, but they're not moving up that volume at the level that they have to. That's why the GM kind of move last week was pretty interesting, even though their sales of Ultium battery-related electric vehicles this year has been quite low compared to their sales of the Chevy Bolt and Bolt EUV.
Corey, appreciate the breakdown. Thanks for the time. Corey Cantor from the New Energy Finance team. And Gabby, thanks to you as well. Gabrielle Coppola leading some of the reporting for the Bloomberg team on that story. We'll continue to track it. Meanwhile, Justin Trudeau's signature environmental law has been struck down by Canada's Supreme Court. We'll have the details on that next. And we do want to mention the S&P 500 again, bouncing off session lows, but still under pressure with a lot of geopolitical angst in the air today. We've obviously seen investors shifting away from tech stocks on this Friday. More market coverage ahead. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. And Matt, we wanted to get to our weekly Bloomberg Greens segment because we had some news here in Canada today. The Supreme Court in this country declaring key parts of a major environmental law unconstitutional, which potentially triggers changes in how the country manages huge industrial projects, energy projects. We want to bring in BNN Bloomberg's Tara Weber, who helps to cover the situation in Alberta, home to many of the energy companies. And Tara, earlier we heard from the federal government's environment minister to get his reaction. But I think a lot of people are looking at this as a blow to the Trudeau government, which has wanted to have a lot more say in the environmental footprint for a lot of big projects in this country.
Yeah, that's a fair point. Canada's made a lot of commitments when it comes to reducing our emissions, to committing to those Paris Accord agreements. So this is a bit of a blow, and that's essentially what the court is ruling here, that maybe they've overstepped in trying to reach those goals. So this was a 5-2 ruling, and ruling that the act does in fact overstep on provincial jurisdiction and that it is largely unconstitutional. So going on to say that it does exceed the bounds of federal jurisdiction and intrudes more incidentally into the province's sphere. So this was an act that was passed by the federal government back in 2019, and the goal here was to review these major infrastructure and resource projects, things like major pipelines. Now, at the time, Ottawa was saying that a tougher approval process would actually make these projects more likely to survive court challenges, which would increase certainty for these companies and their investors. But of course, the industry itself was very much opposed to this, especially the oil industry, arguing it didn't actually increase certainty. In fact, it made things a lot more difficult, and the approval process for major projects became a lot more burdensome and gave too much weight, they said, to input from parties that weren't actually directly impacted.
And briefly, Tara, because you cover all the big energy companies in Canada as well, what would you say, generally speaking, about how, when they commit to new projects, they're thinking about when it comes to their green footprint?
You know, I think most of them already have this very much at top of mind. They don't want to cause environmental damage. They have a lot of their ESG commitments already in place. And when we think of our largest producers, they're part of this Pathways Alliance. So these are the top producers that account for about 95% of the oil sands production here. And they've already committed to net zero greenhouse gas emissions by the time we get to 2050. So they're all already on board. And they felt as though this act was the federal government stepping in many ways and making them jump through even more hurdles than they were already jumping through on their own path. So in that regard, we are seeing a lot of industry groups that are applauding this today, one of which being CAP, the Canadian Association of Petroleum Producers, but, you know, a number of other groups as well, even the Canadian Taxpayers Federation, saying that between 2013 and 2023, this is actually costing Canada, I think, $12.8 billion when it comes to what would have been proceeds from all the jobs and revenue from these projects.
Sounds like less red tape, less regulation, and business will be easier to do. BNN Bloomberg's Tara Weber talking to us about the Supreme Court decision. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd. Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield. Because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
From bonds to currencies and even stocks, investors in search of a haven. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S., and it is risk-off across financial markets today as Israel prepares for a ground invasion of Gaza following the surprise attack by Hamas last weekend. We do see a flight to safety taking place, putting a bid under Treasuries. You see the 10-year yield coming down to 4.63%, pushing yields overall lower. For the week, yields are set to fall for the first time since September 1st. Now, gold climbed above $1,900 an ounce. It's currently up by more than 3% after breaking through its 50-day moving average a little bit earlier. And we cap off a volatile week for oil, with WTI ending the week the way it started, with big gains, currently up by more than 5%, approaching $88 a barrel. And when you look at equities, it's pretty much a mixed to lower picture for the major indexes. Losses in big tech stocks more than offsetting the gains in banks as well as energy names. Romaine?
Yeah, certainly a weird week, a volatile week, a weird mix of unease about central bank policy, fears, of course, about the escalating conflict in the Middle East, and trepidation about corporate earnings. That confluence sent investors into haven assets this week in a big way. The Swiss franc at its highest level of the year versus the euro, the dollar up for a fourth week against a broad basket of peers, and you just mentioned gold. Prices just on this day alone surging the most since March, Scarlett. And then, of course, there's Treasuries. Benchmark 10-year yields that went on a roller coaster ride, pulled down by that haven buyers looking for some sort of safety, and then pushed higher by sloppy auctions and hotter than expected inflation data. I think a lot of people would like this week to sort of come and go, but it doesn't necessarily mean what's ahead is going to be any better. The impact on Treasury prices not just coming from investors, but also from the feed-through on deteriorating consumer sentiment. Survey data out from the University of Michigan showing consumers' feelings about current and future economic conditions, they're down. A big part of the reason, consumer expectations for inflation, they're up. They appear to have come unanchored and are drifting higher. Former St. Louis Fed President Jim Bullard saying investors may have to recalibrate as well. Speaking on the sidelines of the IMF meetings in Morocco, Bullard said the market is underpricing the risk that disinflation stalls and core PCE starts to go up again. Some glint of that scenario may be revealed, or I don't know, maybe debunked, Scarlett, by the Q3 corporate earnings and the forecast, which started to roll in this week with the three of the biggest banks, I should say, here in the U.S. actually providing somewhat of an upside surprise.
Yeah, and perhaps expectations were low heading into that, right? Net interest income is the one that we're looking at here. The overall takeaway for the big banks so far, better than expected results. These are the sell-side estimates for the 4 biggest banks' net interest income as we headed into third quarter earnings. And you can see the combined NII over here has pretty much plateaued, with banks paying out more to depositors as they compete for business. JP Morgan, that's the light blue bars section of the bars. It's a bit of an outlier because it added First Republic's customers to its fold after the regional banking stress earlier this year. Now, in terms of stock performance, there's not much love for the banks. What these bars show is the spread between the KBW Bank Index and the S&P 500. And in 2023, it's a 37% difference. That is the most ever. The KBW has tumbled about 24% this year. The S&P 500 is up about 12%. So in addition to higher funding costs banks are contending with unrealized losses in their securities portfolio because of those rising yields and increased bad loan write-offs. And of course, we can't forget there's increased regulation like higher capital requirements looming on the horizon as well.
All right, a lot for investors to parse. Let's see if we can get some insight out of our next guest. Ellen Hazen joining us right now, Chief Market Strategist and Portfolio Manager at FL Putnam Investment Management, helping us kick us off to the close here on this Friday afternoon. And you heard Scarlett going through some of the earnings that we got out of the banks this morning. And the banks obviously give us a read on the financial sector, but more importantly, they kind of give us somewhat of a contour of, I guess, economic conditions, Ellen. And as we head into this earnings season and we start to hear from other companies, from other industries here, do you think that the worst case scenario that everybody seemed to think that might actually now be baked into what happened in the Q3 and we're past that now in Q4?
Well, certainly if you look at the U.S. consumer, they are showing signs of weakness. Now, is that fully reflected in the stock market? Difficult to say. I would say that we're seeing decent responses today out of the bank stocks after what were pretty good numbers today. JP Morgan is up, as you saw. But I would point to what Jane Fraser said on the Citigroup call, where she pointed out that consumers are weakening and that consumers have drawn down their excess savings. So I think that the banks are pricing in a lot of bad news already. So in that sense, we probably have seen the worst. And I don't think it was as bad as folks thought back in March when we saw the string of bank failures. But I do think that that will be a headwind for the banks going forward. The places where you saw strength were primarily in sales and trading, and with lower than expected delinquencies, lower than expected charge-offs. But that can't sustain forever if you're seeing the consumer weaken.
And it's interesting, too, some of the commentary that we've heard from the bank executives this morning, Ellen, they seem to have some, I guess, trepidation, but they also seem to reinforce this idea that in their view, the economy still overall is strong, despite the fact that we know there are a lot of black swans sort of circling right now. But at least the fundamentals themselves, in their view, seems to be solid.
I think that's right. And loan growth wasn't too bad. And as we look at the various parts of the bank's income statement, the weak areas are known, right? You had Wells Fargo talk about the weakness in the office part of the commercial real estate market. So that's a known, and people know that that's going to happen. But just like you see with the PMIs, the services PMI has been fine this whole time while the manufacturing has been poor. If you look at manufacturing, it's beginning to improve. Similarly, if you look at the components of GDP in the most recent quarter, you see increased spending by corporates. And so there are signs that corporations are picking up the spending where consumers might be dropping off a little bit as they've used up some of this excess savings from the COVID era.
So that's a really interesting observation. Do you see that as a clean handoff from consumer spending to corporate spending without too much of a hiccup in the overall economy?
Well, I think a smooth handoff in an economy as large and varied as ours is always a difficult thing to predict. But you are seeing the consumer slow and you are seeing corporate spending pick up. And part of that is being driven by very sustainable causes. In other words, the various federal programs that got put into place between the CHIPS Act and the Inflation Reduction Act and the infrastructure program. There's a lot of spend that's going into corporate spending. And so I do think that there are underlying reasons why the handoff could be smooth. But to forecast that it will be, no, I don't think so. I think there will be some hiccups. But if you can look through that, the underlying fundamental reason is fairly sound.
Okay, you make the case for why corporate spending might be picking up. If we do see consumer spending weakening, how does that affect your allocation? Where do you want to be? Where do you not want to be?
So we're looking at increasing areas that are a little bit less sensitive to the consumer. We're looking at increasing industrials, and we're looking at increasing healthcare. So there are some areas of the consumer that are fine. But as we saw from the airlines recently, parts of the consumer are weakening. And that makes sense. They had a goods-fueled spending binge during COVID, and they had a services-fueled spending binge in the most recent year or so. And that's going to fall off a little bit. So I would rotate out of some of those consumer names into things that are more levered to corporate spending.
What gives you, I guess, a little bit of confidence about the industrial space, Ellen? Because when I hear that, I guess it kind of makes sense, but then I worry if we're talking about maybe the potential for economic conditions to soften here, aren't a lot of those names going to be tied to that cyclicality?
The question is whether or not we have a hard landing, a soft landing, or an elongated cycle. If we have a hard landing, then I agree with you. Corporations and industrials will be negatively impacted. But so far, the data is not pointing that way. We've all seen the strength of the labor market. We've all seen the strength of the services sector. And so absent a hard landing, I think the industrial sector can be okay. And certainly, as I said, we have a lot of fiscal spending backing it up.
I know you're a long-term manager, but I do wonder, Ellen, if you are concerned about some of the volatility we've seen, particularly in asset classes that typically don't see that type of volatility, like the Treasury market.
Well, the Treasury market has had 15 years of very unusually low interest rate suppression, some call it, and we're exiting that phase now. And if the Fed holds the course, which certainly it seems at the moment that that's what they're signaling that they'll do, then the whole economy is going to have to go through an adjustment phase to a structurally higher cost of capital with, oh my goodness, positive real interest rates, which wasn't true for a long time. So yeah, some things will break when that happens. And you do see that with the Treasury market in conjunction with some of the way that the Treasury had run down their account and they need to build it back up and so forth. So there are some mechanical reasons as well. But ultimately, I think what we're seeing is a reversal of this 40-year secular reduction in long-term interest rates to very, very low, I would argue unnaturally low levels. We're seeing that go back to something like normal, and it will be a little bit disruptive, but I don't think that it is the sign of impending devastation.
All right, a wealth of experience, and always great to get your insights out of you, Ellen. Have a great weekend. Ellen Hazen there, Chief Market Strategist over at FL Putnam Investment Management, helping us kick us off to the close here on a Friday afternoon where we got a slew of bank earnings this morning, including Wells Fargo. A conversation coming up with the CFO, Mike Santomassimo, on the heels of that earnings beat.
Plus, central bankers and finance ministers are gathering in Morocco for the IMF and World Bank annual meetings. ECB President Christine Lagarde shares her thinking on what's next in the bank's fight against inflation.
And we're going to check in on the tech space with veteran Wedbush analyst Dan Ives. He'll be joining us primarily to talk about what he's been seeing with data analytics giant Palantir, as well as some of its peers. That conversation and so much more. Stick with us. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
at big bank earnings kicking off this morning. We heard from Citigroup, we heard from JP Morgan, and we heard from Wells Fargo. And so far, well, so good. A firm beat of analyst expectations here. Net interest income topping expectations, and the full year guidance getting nudged higher. Pleased to say that the Chief Financial Officer of Wells Fargo is joining us right now, Mike Zanamassimo. Mike, great to have you back here on the program here. Let's start off here with the net interest income here. I think overall, most investors were pretty pleased with that number. What actually led to that beat?
Yeah, no, we were pleased with the quarter overall, and I think what you saw in the results was just the benefit we're getting from higher rates. And as we looked at the earlier in the year, we were sort of trying to get a sense of how deposits were going to move, what kind of mix shift we were going to see, and what pricing was going to look like. And as we get better clarity throughout the year, we were able to realize more of those benefits than we thought at the beginning of the year, and that helped us increase our guidance for the year up 16% versus the 14% we talked about in July. And I think you see that come through in the results there, net interest income.
Well, given the trajectory of benchmark rates, and more importantly, some of the volatility in that path, when does this higher rate environment, if at all, and the balance that you, of course, have to have with your consumers, when does that start to work against you?
Well, I think you got to think of it in a little broader sense, right? I think the economy is definitely slowing as a result of rates coming up, and so that's having an impact on consumers. We're still seeing it be much more resilient than we would have expected at this point, but we're seeing good activity levels, but cash balances are coming down. And as the longer rates stay higher, our deposit costs will continue to increase like you've seen over the last couple quarters. Having said that, I think when you look at the overall mix of our business, we're very much weighted more towards the consumer side. Those are accounts generally, the majority of them at least, generally have smaller dollar amounts in them, and so you see a little bit less pressure from a pricing perspective there so far.
Less pressure from a pricing perspective. What is your base case scenario, Mike, for the cost of deposits? Has the process for raising the rates that you pay depositors mostly run its course? I mean, are you 70% of the way through, you think? 80%?
Yeah, it's really hard to know. I think that it'll be a function of where rates go from here, whether they go up further, whether they stay flat for a longer period of time, and so I think it'll really be that. But really where we're focused is making sure that we continue to do more with customers too, right? So you see that come through our credit card results, where we've got really good originations and growth in credit card spend. And you see that, you're hopefully starting to see that in our wealth management business. And so I think hopefully over time we'll do more and more with customers to kind of round out the relationships there.
Right, gotcha. I got to ask you about bank capital rules, because that's something that so many of the bank leaders have warned about and have talked about. It hasn't happened yet, but I wonder what actions you'll have to take as preparation for this to happen. What steps have you taken so far?
Yeah, well, first, I think we come into this this rulemaking and environment in a really strong position. Our capital levels are high, and we're already at the level we need to be if the rules were implemented as written, today. Mm-hmm. So we come in with a lot of flexibility, which is good. Now, it's a complicated set of rules. It's going to take the better part of a year to finalize. And so, and we're going to, go, rule by rule or section by section to make sure that we're doing the right things there. But it's a little early to start taking too many actions right now. But we do need to be cognizant of like some of the places that are going to be a little more challenged as a result from a return perspective. But it's going to take some time to really play out, and we look forward to continuing to engage with the regulators through the comment period, and we're hopeful there'll be some changes made, but we're prepared to deal with whatever comes as when the rules get finalized.
Well, and I'm sure, as you know, Mike, this still kind of almost seems to be a rolling issue right now, because we still haven't quite figured out exactly what happened with the regional banks earlier this spring, and there's a lot of concerns about the commercial property market going forward, all things that I think would weigh into the decision as to just how much to impose upon the banks by regulators.
Well, I think you have to, take a little bit of a bigger, picture here, and look, the banks are in really good shape and overall, and I think when you look at, Wells Fargo in particular, I think we're in great shape and we have strong capital, we have strong liquidity levels, we have, good coverage against credit losses that are there. We have a smaller markets-oriented business than many of the other big banks, so we're maybe in a little bit of a different, position. And so I think you have to let it sort of play out. And I think, when you think about the capital levels that have increased in the industry over a very long period of time, it's been a lot. And so, how much more do you need to do from here, I think, is an open question, and we look forward to, engaging with them on that.
I am curious about some of the strategy changes that have taken place under Charlie Scharf, and I'm sure Jamie Dimon even gave a hat tip to his former protege a little bit earlier on his conference call. When you consider some of the moves that have certainly reshaped not only the revenue sources, or at least the percentage of revenue that you're getting from certain sources here, what becomes longer term the way you plan out to protect those businesses, or at least to set them up in a way where that revenue stream is sustainable longer term?
Yeah, well, it starts with having a really clear strategy of who we want to serve, and I think that's what we've been trying to focus on, and I know Charlie's been focusing on since he came to Wells. And I think you've seen us take a lot of action to sort of, orient the businesses to what we think the strategies are. And then it just takes, very methodical, disciplined investment in those businesses over a very long period of time. And I think you're starting to see some of the benefits of what we've done over the last few years, including our credit card business. We're seeing some benefits in our wealth business. We've been investing in our investment banking business as well by adding people, particularly in the last, year and a half or so. And so I think you'll start to see those benefits come through, and that's the way you sort of set yourself up for success over a long period of time, is make sure you got the right capabilities, the right products, the right people, and you do that in a very disciplined way while we continue to fix all of the risk and regulatory work that we've got to get done. And I think that's what you'll see and what will set us up for success over time.
It's a long to-do list, Mike. Good luck to you. Mike Santomassimo is the CFO of Wells Fargo Bank. We're going to stick with the big banks and turn to Citi now, which also reported results this morning. The firm going through a major overhaul. It trimmed headcount by another 2,000 jobs in the third quarter, bringing total severance charges for the year to $650 million. Bloomberg's Jenny Serrain, who broke the news, has more with us now. And how much of this is tied to Jane Fraser's overall restructuring efforts?
Yeah, so the 2,000 jobs that you just outlined are actually completely separate. So that's some of the work that they're doing kind of heading into the overhaul to, slim down and make sure that they're acting in as simple of a way as possible. But this broader overhaul and kind of the changes that Jane laid out last month, CEO Jane Fraser, that's actually all to come. So you're just seeing Citigroup take a lot of really big swings here. You really see Jane trying to kind of get her ship in order. She laid out the strategy at Investor Day over a year ago now, and you really just see her starting to make the organizational changes that's necessary to make sure that the bank is kind of firing on all cylinders and really aligned with that strategy that she laid out last year.
What is the bigger plan? I understand the organizational changes maybe sort of grease the wheels here, but has she articulated sort of what the end game is?
Yeah, I mean, I think her big thing is that her returns need to get in line with peers. And so she's found, at least in her mind, these 5 businesses that she thinks will really get them there. So that's wealth management, trading, the U.S. consumer offerings, her services business, that's what she likes to call the crown jewel of Citi. So that's like treasury management, security services, and then banking. So good old-fashioned investment banking.
Yeah. And as part of that, it's also divesting a lot of the retail branches in overseas markets. Any progress on that front?
Yeah, so that was last year again, or I guess 2 years ago now. They announced that they're going to get out of over a dozen retail units overseas. They're pretty close, actually. So they're in the final stages of the sales, and then they've had to wind down a couple, like Russia, China, Korea, and so they're about 2/3 of the way through that work. Mexico is the kind of big outstanding one there. So that sale process was thwarted by President AMLO earlier this year, and so they're now going to IPO that business probably in 2025. So in various stages, it's a long road to go. I mean, she's got a lot more work to do on this front. A
lot of talk about, I guess, the jobs she's cutting and some of the fat that she's trimming here, but where is she adding resources?
Yeah, so it's interesting because they, like we talked about, they've cut 2,000 jobs just in this quarter alone, but headcount was flat. So even as they're cutting all these jobs, they're still adding a ton of headcount. And really what they've said on that is it's technology workers, as you might imagine, but they're also still under these consent orders from 3 years ago that they got from the OCC and the Fed, and so they've needed to hire a lot of folks to come in and kind of do that transformation work.
Compliance.
Yes.
Do Citigroup employees get free Citi bikes here in New York?
I think they do have some sort of deal for them. Yeah,
I've always wondered. I mean, it seems
get a
logical.
Discount if
a discount.
A discount.
Yeah, exactly. I think, yeah, it's but now that it's owned by Lyft, it might be different.
I mean, if you want to, if you want to hire the creme of the creme, free bike rides every day.
Yeah.
I'd sign up.
It's a nice thing.
All right,
Discounts. Jenny Serrain, thank you so much. Bloomberg's Jenny Serrain covers the banks here in the U.S. and soon we'll be off to London to cover European banks. We've got much more ahead. This is The Close on Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
All right, the end of an era is upon us. The way we consume media has been changing for quite a while, but now we're really starting to see it accelerate, at least for some of us of a certain age. DVDs, Scarlet Fu, are going to be no more on the shelves of Best Buy. You remember, of course, last month, back in September, Netflix basically delivered its final DVD ever.
Much to Abigail Doolittle's dismay.
Yeah, and now Best Buy is saying that after this year, no DVDs on its shelves anymore.
You know where they're still going to have DVDs? The library. The public library will always have DVDs available to
Are you one of those people? Do you go to the library and watch
I do go to the
videos?
library a lot, but I don't borrow DVDs. But that's because I have several Case Logic binders of DVDs I don't know what to do with.
Case Logic binders.
Yeah, remember those?
Scarlet Fu, I thought you were younger than me.
It's in a closet somewhere, hiding. I think Being John Malkovich is in there,
Being John Malkovich?
Yeah. Come on, Gen X, Romaine.
Scarlet Fu in our DVD collection. That conversation coming up after the break. Stick with us. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
for something as universally important to human life as sleep. Mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We continue to see that sell-off in stocks. We continue to see a rally in bonds, and there's a big bid coming in right now in the oil space. Abigail Doolittle is standing by right now with a closer look at the commodity space with our commodities close.
There certainly is. We have a lot of strength for commodities, and I will say first, if there was a commodity for DVDs, it would be up 100% because I will now be out there buying tons of DVDs. But in all seriousness, take a look at commodities. This space up nearly about 2% overall. Oil really the big gainer here, up 5.8%, the best day going back to March. And of course, there is a war premium, fears that supplies could become a little bit more scarce around the Middle East conflict. Same deal for natural gas, for European natural gas, I should say. Over the last 5 to 6 days, up about more than 30%. One oil field was closed down. An offshore oil field was closed down off the coast of Israel, Chevron's field. So there is a premium there as well. And then take a look at the precious metals soaring. Gold up the most since April. Silver up the most since July. All of this as the Bloomberg Dollar Index is up for a second day in a row. So we're going into this weekend with these fears, these geopolitical fears. And if we take a quick look at the oil chart, what could be next? Well, it's interesting because there's been so much volatility for oil. We, of course, had this massive rally higher and then the move down. But you can see that there's basically an uptrend holding. Oil now, Romaine, is back above the 50-day moving average. This appears to be a bottoming pattern. This chart may suggest that we're going to see oil go back toward its recent highs, maybe even higher.
All right, a great wrap up there by Abigail Doolittle here. We want to stick here in the geopolitical world right now and some of that instability that Abigail was referring to. That's dominating the conversations at the IMF World Bank meetings in Morocco. Christine Lagarde, the head of the ECB, sat down with Tom Keene a little bit earlier to talk about the challenges facing central bank policymakers.
There are multiple previous shocks, from the disruption to the supply bottlenecks, to the immense volatility of energy prices, to the pent-up demand against the restricted supply, and all of that happening in a very abrupt and sudden way. So that's number one. Number two, something which is affected by lag time, or time lag, whatever you call it. And I'm not here talking about monetary policy. I'm here talking about the adjustment of wages to inflation. And there is clearly in everybody, in all central bankers' mind, the fear of the second round effect. Is it happening? Is it likely to happen? Are we at the peak, and are we now going to see declining wage increases returning to real wage a la pre-COVID? Question mark. That's another moving part. The third moving part is what I would call the strong. You know, we did 450 basis points hike in 15 months. Which is a huge, unprecedented increase. And this is what I call the strong but lagged policies. We haven't seen the end of it yet. We're seeing tightening of financing conditions like it has never happened before. We know that there is some more in the pipeline, and how it is going to impact our economies, how it will have deflationary impact, disinflationary impact in our region is also to be seen. And the final one, sort of really ball in the air is the structural reforms that will come out of all that. There is what, Ngozi, you call the, did you say re-globalization? I would call it probably consistent with a good fight against climate change. The near-shoring, not reshoring, not friend-shoring, but reducing the distance, having a better handle and control over your supply chain and the logistic and transportation. That's just one example. I think the labor market is also a case in point where we will be seeing structural reforms and where the people who are joining the market now have different aspirations, different expectations than what we had, but let alone the two grandmothers at the table here. All of you, the Z generation, will not want the same thing. So those are all these balls in the air. We're not exactly sure how they're going to land, but certainly we all have to focus on our policies as far as the European Central Bank is concerned. As I've said before, our aim, our mission is to return inflation to 2% medium term, and we will. And it is happening as we speak, and we will hang on to that, be steady, long enough, and ready to do more if necessary.
And the head of the European Central Bank, Christine Lagarde, speaking a little bit earlier with Tom Keene out in Morocco, where the IMF and World Bank actually holding for the first time their semi-annual meetings on the continent of Africa here. Interesting to hear some of the commentary by Lagarde as well as some of the other policymakers. And they do all seem to be singing from the same hymnal. They may not have the same policy, but they all seem to kind of be on the same page when it comes to that sort of confluence of economic conditions.
Absolutely. And of course, the conflict in the Middle East just raises their concerns even more. I mean, you think about Europe in particular, they have to deal with rising natural gas prices. Already, Ukraine was a big concern. Now you've got the Middle East to add to that. Once upon a time, you just looked at weather patterns and whether it was going to be a brutal winter. It's a real calculus that policymakers have to consider here.
It'll be interesting too. I mean, there was obviously a little bit of a visceral reaction in the currency market, I should say, in the bond market for that matter, over in Europe, to some of the guidance, or I guess the perceived guidance that she might have communicated here. I think people want to see her maybe shift policy in a way. I guess that's at least the market. They always want it to shift, right? Do what's favorable for the markets is what they want. At least for right now, I think she's trying to do what's favorable in her mind for the economy.
Yes, and for tackling inflation, which is their only mandate, really. All right, still ahead, we've got cybersecurity and geopolitics, how those two intersect. We're going to discuss how cloud software companies like Palantir could increase demand for their services in times of global conflict. This is The Close on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper. Off
really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd. Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
From the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Oshkosh, the maker of military vehicles and fire engines, upgraded to buy over at Citi, with the analysts calling it an outlier on earnings momentum within the machinery sector. He also sees a lot of margin upside in that new vocational segment that the company just formed, which actually includes those fire trucks. Shares had been up almost 2% on the day, but gave that back and then some. Next up, let's take a look at Netflix. Cut to Pure Perform over at Wolfe Research. The analyst there says average revenue per user expectations for next year may appear to look, quote, full, but could actually lead to shortfalls in gross additions. Shares of Netflix down about 2% on the day. And finally, a wild story right now involving JD.com. Several firms on Wall Street either downgrading the company or cutting the price target in the past 2 days alone. That includes an equal weight cut over at Morgan Stanley this morning. This is on the back of reports about the arrest of a man in China with the same last name as the chairman of JD.com. Now, this has not been confirmed here, but investors are speculating, and analysts on the street aren't waiting to actually pull the trigger here. JD.com, which fell 8% yesterday, down another 3% here today. And those are some of our top calls. All right, we do want to stay in the tech space here and fold it into some of the current geopolitical events going on right now. The unrest between Israel and Hamas could drive global spending on cybersecurity and analytics. Cloud security providers such as CrowdStrike, Zscaler, and Palantir may be able to upsell both government and private entities for their services. Dan Ives has been covering this sector and knows it better than anyone. Senior equity analyst over at Wedbush joins us right now. And Dan, let's start off here with, I guess, the potential opportunity. We know there's been a big push by corporations and governments, for that matter, to beef up their cybersecurity defenses, if you will, here. How much do you think the current conflict unfolding right now in the Middle East could accelerate that?
Look, I mean, the tragic events that we've seen, I think it's one from a cybersecurity perspective. This is not just from a government perspective that we're seeing just in the U.S. or in Israel, but I think what we're seeing across enterprises is you are seeing cybersecurity spend that's going to be up 20% next year, regardless of what we saw this year. And I think that's important because this is becoming, from a high priority perspective, names like CrowdStrike, Zscaler, Palo Alto, Checkpoint, where again, with a lot of them actually based either in Israel or huge R&D. I mean, this is actually a golden age for cybersecurity. And I think what you're seeing more and more is how important it is becoming even in the geopolitical landscape.
I'm curious about, when we talk about these cybersecurity companies, it seems at times that it is somewhat diverse or dispersed, I guess is the word I'm looking for here. And I'm wondering if we do end up seeing some degree of consolidation among some of these players.
Yeah, look, I think we are going to see a surge, a tidal wave of M&A.
Yeah.
And I think this is really get out the popcorn moment for that. I mean, we've started to see some M&A in terms of Cisco, Splunk.
Yeah.
I think that's just the start, because this is really going to be a golden age for cybersecurity. And when you look what's happened with AI, we believe this is actually going into a 3Q earnings season where tech stocks rip higher, despite what clearly is a nerve-wracking environment and a lot of agita up there. And I think that's really going to be the theme here. Cloud, cybersecurity, big tech leads us higher.
So when we talk about M&A, I'm fascinated by that. Are we thinking more companies like Cisco, old tech companies, buying some of these players, or consolidation between the little players themselves?
Well, I think you're going to have the strategics. You look at what I believe like Oracle. I think Microsoft could do more deals. I think Adobe and some others. And look what happened with Microsoft Activision. I mean, that was a black eye for Khan and the FTC. That's really showing big tech flexing muscles. They're not worried too much about the 202 area code. So you're going to see the strategic deals, and then I think financial. I think financial, you look at PE and M&A. I mean, this is going to be it's a get out the popcorn moment. I believe we are going to see M&A massively spike over the next 3 to 6 months.
All right, get out the popcorn moment is certainly one way to think about it. I want to focus in on Palantir in particular, because with the conflict in the Middle East, you say that Palantir will be a key partner of Israel. We already know Palantir is a key partner of the U.S. government as well. Is it limited in any way in terms of how many governments it can partner with?
Well, it's not. Look, let's take a step back. As a pure play AI name, it's probably the best software out there from core AI, what Karp and Palantir have done. When it comes to defense, that's clearly their strength, right? So they will be the eyes and ears, especially for Israel, IDF. We've seen that in the U.S. as well. I mean, Palantir, you talk about defense budgets and where this is all going, strategically the top of the list. And I think it just shows more and more, even as they've gone into enterprises. Palantir, I still believe, is a very underappreciated story by investors that really don't understand what could really be the full, what I believe, AI story playing out here.
I am curious about that too, because I understand that there's a certain black box with this company that is kind of a necessity given some of what they do here. But I also feel that we don't necessarily hear enough sometimes from the executives there. We don't see them as much here. Does that matter to you?
Yeah, look, I think there's no doubt. I think by nature of what they do, there's a lot of stuff that they can talk about. I do believe they have started, we were at a customer conference, a month or two ago. I mean, they've started to be a little, from an investor perspective, a little more open. But I think that's going to be part of the story. I mean, if you look at Karp and Palantir building, and we've called it, what I view as probably one of the gems in AI, and I think it's just starting here. Defense was actually their roots. Enterprise and going forward, that's really going to be a lot of the core growth. We believe this is really going to be an AI revolution with Palantir playing a major role.
All right, it's at the leading edge there, certainly. Dan Ives, really appreciate you joining us, coming in here on a Friday. Dan Ives of Wedbush. Now, all out for Palestine protests are taking place globally, and we see in New York City, they've boosted their security. You can see right now, live shot, this is lower Manhattan, Midtown Manhattan, outside Baruch College in about 25th Street and Lexington. We're going to dive into how the city has prepared for these protests. That's next. This is The Close on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Take is focused on the conflict between Israel and Hamas and its potential to disrupt the world economy and perhaps even tip it into recession if more countries are drawn in. Bloomberg Economics chief economist Tom Orlik is here now to discuss. And Tom, a lot of this revolves around what the scenario looks like, whether this is a confined war, a proxy war, or a direct war. In the best case scenario, a confined war, I guess if you can put it best in quote marks, what are we thinking in terms of the impact on the global economy?
So, primarily, of course, Scarlett, the events unfolding now in the Middle East are a human tragedy, and I think that's top of mind for everybody. Our piece takes on the potential economic impact, and we think through a number of scenarios. Now, if we start with the confined war scenario, that's where we are today. That's Israeli forces leveling Gaza. Potentially, it's skirmishes between Israeli forces and Hezbollah, but it doesn't blow up into a broader regional conflagration. If that happens, probably you see oil prices a little bit higher. Indeed, we've seen oil prices move a little bit higher since the beginning of the conflict, but the impact on the global economy is pretty limited.
There's obviously a lot of concerns here about this broadening out into, I guess, an old-fashioned, full-scale head-to-head war. There's also a lot of concerns, Tom, I'm sure you know, about sort of another sort of layer of the proxy wars that we've seen in the Middle East over the past few decades.
I think that's completely right, Romain. And of course, we've seen US Treasury Secretary Janet Yellen speaking today and talking about how important it is that this doesn't blow up into a broader regional conflict. Now, in our big take, we also consider that unwished for scenario. And we think about what might happen if this isn't just Israel and Hamas. It's not just Israel and Iranian proxies in Lebanon and Syria, but it blows up into a direct confrontation between Israel and Iran. And if that happens, the scenario we construct, based on what's happened in past wars in the region, is for really a very, very sharp rise in oil prices. If oil prices go from all the way where they are now to $150 a barrel, our models tell us that would take a full percentage point off global growth. That would take global growth for 2024 all the way down to 1.7%, the lowest level since the early 1980s. So that's a risk scenario, maybe even a low probability risk scenario. It's not where we are today, but as tensions continue to rise, as emotions run extremely high, it's a possibility that we need to start thinking about.
Yeah, and I know you don't get into this in the big take story, but having been someone who's covered China and looked at Asia, there's a lot of questions as well whether other countries might take advantage of this moment of conflict to perhaps pursue their own aims. China, Taiwan, for instance. How are you starting to think through some of that? Because that always comes up every time there's any kind of conflict where a country invades another.
Yeah, I mean, certainly, if we think about the geopolitical risks which have the capacity to significantly move the dial on global growth, then Taiwan would come near the top of that list. Yeah. And we have an election in Taiwan in January, which potentially is a moment where we could see tensions increasing. I think if you speak to the kind of China strategists and the Taiwan strategists, though, what they would tell you is actually the status quo in the Taiwan Strait, the uneasy stability, it's pretty sticky and not likely to change anytime soon.
All right, Tom Orlik, there are our chief economist over at Bloomberg Economics with the global view of those geopolitical conflicts now unfolding. And back here at home, near our Bloomberg World headquarters, protests are now taking place here in the streets in support of Palestine. Joining us right now is Bloomberg New York Bureau Chief Katya Borzakansky to talk a little bit more about this. And I think a lot of folks in the city were on edge when word got out that these protests were being organized. What do we know about the organizers?
We know that they're a variety of different groups, and they're coming together across various protests. I mean, they're all over the city. we had a reporter who attended the ones at Columbia University yesterday. There's one large one that's going to take place imminently in Times Square with a host of different groups attached to the flyer.
Right.
Hard to know if they're actually affiliated with it. And then we have also on CUNY campuses, they're popping up all over.
And I think that's what we're looking at right here, which is Baruch College in Manhattan. What is Mayor Eric Adams saying about the city's preparation for all of this?
So the mayor and the NYPD keep stressing that there are no credible imminent threats. And while a lot of people are on edge to go about your daily life, that you're going to be protected, that you're going to be fine, they've boosted security at synagogues, at mosques, at schools, throughout the transit system, and you can just generally see an elevated police presence around the city. Several friends have texted and said, they're boosting security guards at my kid's preschool or wherever, even places that aren't religious institutions.
Do we have a sense here that some of these stepped up security measures are going to be here to stay for a while until whatever is going on in the Middle East is resolved?
That's a good question. I mean, given that there's probably no imminent solution to what's happening, there'll probably be responses to just with the societal unrest, right? Like this was known to be the day of rage, and so there's been anxiety in the Jewish community for the last several days. Social media has been aflutter with paranoia about what would happen today. And so I think there's a response to that. Mayor Eric Adams is very close to the Jewish community here in New York City. So there is a direct response to that constituency.
And we've seen this a lot in New York City, where we have some incident overseas, and then of course they have to step up the protection of synagogues and other places of worship in order to make sure that people feel comfortable.
Of course, it's nothing new. They also do it during the High Holy Days.
All right, Katya Porzakansi, thank you so much, New York's bureau chief here for Bloomberg News. And Romain, a lot of people didn't make it into the office today because of these protests. I mean, it was pretty empty at the garage when I parked my car this morning.
Yeah, it was hard to kind of know what to make of this, right? I mean, it's one thing to say, okay, we're going to come out and protest, but I guess as long as it's peaceful, but I think it scared a lot of people away, not just because of those protesters, but I think there was this fear that you're going to have counter-protesters, and then that could cause some issues. At least for right now, we don't have any reports of any significant incidents there. We will keep an eye on that here as we march to the closing bells here. We're about to round out into the final hour of trading here on this Friday afternoon for the week. Another wild week that has stocks on the back foot on the day, though. Some of the indices still clinging to weekly gains, believe it or not, Scarlett.
Yeah, but that's a lot of red on the screen right now, really highlighting the risk-off sense as people are really on edge with concern about what's going to happen next in this Middle East conflict.
A flight that you see there into Treasuries here on this Friday afternoon, a flight into the Swiss franc, seeing similar flights into gold as well. Stick with us. Romain Bostic and Scarlett Fu. This is The Close on Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Just about 3 p.m. here in New York. This is the countdown to the close. Romaine Bostick here.
And I'm Scarlett Fu.
Interesting day here in the market, Scarlett. Kind of a little bit of a rinse, repeat. But this is a market right now that has really kind of been left to its own devices. We talk about whether they're focused on macro conditions, whether they're focused on the war in the Middle East, or whether they're just trying to figure out whether companies are actually going to finally sort of call that earnings trough and we're going to start to see something better in the fourth quarter.
Well, there are a lot of expectations and hopes that maybe the earnings recession ends for the third quarter numbers, but it's still early days. And we did get numbers out of the banks that suggest that things are looking better, or at least they're not looking worse. But it's really interesting that on a day like today, you have banks outperforming and big tech down. What happened to big tech being a safe haven?
I think I think people are going to the traditional havens. At least we've seen that over the last couple of days. Remember, a lot of those haven bids that we had seen before seem to be driven less by those geopolitical issues and more by macroeconomic conditions. And I think this time, when you get the rubber hits the road, when you are talking about war and the potential for a spread of that conflict here, what do you go to? You go to the franc, you go to the yen, you go to treasuries, you go to the dollar.
You go to gold.
And gold, yeah, good point there. And you see that. Gold actually having one of its best days in about 6 months now. WTI crude having one of its best days in quite some time here, not necessarily for the right reasons. And if you flip up the board real quick, too, I mean, we have to talk about the volatility and pretty much the volatility in the Treasury market. I'm going to just borrow a line from John Farrell that said, the Treasury market is trading like a penny stock some days, it looks like. And we've talked about, what was it, a couple days ago, we had that big surge in yields, and then we had the big drop in yields back down. And I mean, gosh only knows what we're going to see on Monday. And you see, and just for our viewers, that white line, that's the move index there. And the blue line, that's the VIX. And that's the disconnect here, because normally you would expect that VIX to really perk up, or at least some of the equity measures of volatility to pick up. But no, it's the white line.
Yeah, it's really interesting how equity volatility is really tamped down, while something like TLT, which is the ETF that tracks longer dated maturities bonds, have been making 2% plus moves 3 times this week already. You don't normally see that.
I wonder if this drives a lot of people to the sidelines as well, because you can say, oh, a lot of money was made, and a lot of money was made, and what was it, oil stocks this week, XOP having a great week, obviously defense stocks. But you also get a sense here that if the situation in the Middle East does tamp down and we find a somewhat reasonable solution to it, then does that trade get unwound pretty fast?
Yeah, perhaps, although I don't know that anyone's looking for a near-term solution to what's happening in the Middle East. Let's take a look at some of the outperformers on the day. The big banks, because you had JP Morgan, Wells Fargo, and Citigroup reporting. Citigroup actually just turned lower.
Citigroup can never catch a break on its earnings day.
Well, and maybe that's why it's making some big moves, cutting jobs and restructuring everything, and really looking at its expenses with a closer eye. But overall, better than expected numbers, lifting those banks. I wonder to what extent banks are really a read on the overall economy, as opposed to just a read on monetary policy.
I know there are a lot of people that sort of doubt, I guess, just how much of a read they give. I'm actually a believer, because I do think, particularly with the banks that have large consumer operations, so like a Wells Fargo, Bank of America, even Citi to a certain extent, you do get more of the contours, I guess, of what the shape of the economy
what
is.
Demand
right
looks like.
Yeah, because you can see, loan loss reserves and delinquencies and mortgage activity, and so
credit cards.
You get some sense.
Yeah. All right. Well, let's take a look at what's going on in Boeing because it is the biggest decliner in the Dow Industrials. I know.
Close your eyes, folks.
Yeah, it's not a pretty chart. Look at that. It is off by more than 3% right now. Signs of worsening 737 MAX aircraft production issues. It continues to dog this defense company, which, by and large, most defense stocks have been doing fairly well in the last couple of days.
Yeah, but this is just such an idiosyncratic story right now with Boeing and just dealing with some of the supply chain issues. Spirit Aerosystems, of course, also down hard here on the day.
All right, and Dollar General, we're seeing a relief rally in this beleaguered dollar store chain. The CEO, Jeff Owen, has stepped down. He was at the helm for almost 1 year, and I was looking, the stock plunged about 60% during his tenure. There were also a lot of workplace safety concerns that have been published, and Bloomberg Business Week did a deep dive into what's been going on at Dollar General.
There's been a lot of great stories here about just their labor practices and the way they run their stores, and I'm glad you brought up the stock thing because I think investors, they focus on those anecdotal stories about what's going on in stores, but you have to forget, when you talk about return to investors, it just hasn't been there.
Well, the former CEO has come back. It's kind of like a Bob Iger situation over at Dollar General.
Don't say that. Bob isn't doing too well.
Well, how about initially when Bob Iger
You know what could help Bob Iger? Bring back DVDs. How about that? I think Abigail Doolittle, I think, could provide at least a couple of percentage points of margin boost for that name as well. All right, Scarlett, we got to get back, I guess, to the broader market here as we count down to the close. Just about 55 minutes until we get there. Melissa Brown, she's joining us right now to help us count down to those bells. She's the Managing Director of Applied Research over at Axioma. Great to talk to you again, Melissa. And I want to talk, just a minute ago, I was showing Scarlett a chart of some of the volatility we're seeing in treasuries, and that's not a news story. But I'm also interested in why we don't see that same type of volatility in the equity space, at least with regards to the normal measures that we look at, like the VIX.
I think it's really interesting that we're not seeing that kind of volatility. It's a little bit puzzling to us. I think, when we see that coupled with low trading volume, I think that it tells us that investors maybe don't know what to do, so they're not doing anything. And as long as they're not doing anything, stock prices are staying within a relatively narrow range on a day-to-day basis. In the third quarter, we saw only a few days where stocks moved up or down by more than 1%, which was a huge contrast to what we saw even in the second quarter. So I think it's just a wait and see kind of approach.
It also raises the question, Melissa, that I think is like, how many people are even in this market? I mean, we know that the folks in the Treasury market have kind of left, at least to a certain extent. And it seems like to a certain extent, when you look at trading bonds, not just the volatility, but the actual bonds itself, it's just a lot of people that are just still on the sidelines.
I think that's true. I think when rates started to go up earlier this year or late last year, you did have money move from equities into bonds. I think now with Treasury yields being relatively high, you can certainly get a decent return by just keeping your money in cash for right now. And if you don't have a clear direction of what you want to be doing, you might as well do that.
We talk about Treasury yields being high, but for the week, they are actually set to fall for the first time since September 1st. So what is that? 1, 2, 3, 4, 5, 6 weeks. What is the argument for why Treasury yields may have peaked and are now unlikely to go beyond where they got to at the end of last week?
Well, I think there's mainly speculation that the Fed is done raising rates. And so, the next move when it comes is likely to be down. And so I think that, is maybe keeping a lid on rates at both the long end and the short end, I would say. So, I think that's probably the reason that we are seeing those yields come down. But